So welcome back everyone, and today we are talking about the crash course for the current issues. Okay, and this so today we'll just take about few chapters, and then tomorrow we'll complete it. So let's begin with the very first chapter, and that is reading 96, 2023 bank failures, preliminary lessons learned for resolution. Now, the entire thing that we have here is all about the resolution aspect. Like what happens in a crisis, we just talk about that briefly. And then, majorly, we are talking about the resolution. Like what lessons do we learn for the next, uh, so that we are aware about what to do. That's what the entire focus is all about. And as you see that the crisis is of 2023, the bank failures that we had at that point in time. So this is just a resolution, things that we can improve upon. That's what the focus here is. So let's try to understand some definitions here, and that is a bail-in versus a bailout. Now we all know that what is a bailout. Bailout means uh, it basically the government steps in, uses the taxpayers' money to uh, protect or to basically to uh, ideally to protect creditors by injecting money. So here the taxpayers money is being used in protecting a particular company, or just getting out of that difficult situation for a company. That is what we mean by a bailout. But when it comes to a bail-in, what bail-in refers to is that all the creditors, depositors, shareholders of a particular bank or a failing institution, they would absorb all the losses. Okay, so this is a situation wherein if I'm a particular shareholder of a bank, and if the bank defaults, right, if there's a bad situation in a bank, then I'll be the first person to actually default in this situation. So here in a bail-in, no people's or the taxpayers' money is used. So that's the differentiation. There's also a concept of a TLAC, which is a total loss absorbing capacity. As the name suggests, you have certain kind of a bonds specific in this chapter. We call it as a additional tier one bonds, or like COCOs, contingent convertibles. They are the perfect example. So in the equity of a balance sheet, you have certain common bonds that we have. That is what we refer it to as a TLAC. So when you hear this thing, it's nothing but a sub component of an equity, the core equity that we have, specific COCO bonds. That is what we refer it to as a TLAC. Now, the very first learning objective, it talks about evaluate the Credit Suisse case and its implications for the international resolution framework. All right, so we have to evaluate this, and again, as I said, the entire thought process is learning about the resolutions. That is a main takeaway. So what I've done here is that I've created a timeline that will help you to actually uh, analyze or evaluate the time of events. So this is very important. Know this thing, you'd be good to go. So initially, all the things started in mid 2022. There was new management, there was some sort of a scandal, all the other things that happened in Credit Suisse at that point in time. So new management was appointed due to some liquidity stress. By the August 2022, there was a ratings downgrade for Credit Suisse, and this impacted significant liquidity stress. But again, they still had 180%, almost as good as two times the liquidity to manage in the October 2022. Then we have November 2022, further ratings were downgraded. See, when you appoint new management, it takes time. So to basically turn around the situation, to have that operational efficiency, and so on and so forth. But again, here in this November 2022, there was a further ratings downgrade. This was still kind of like a manageable, I would say that, in the year 2022. But the year 2023, on March 9, there was a SVB bank collapse in the US that led to fear about the liquidity situation in Credit Suisse. So by March 14th, right, just almost after a week, they delayed in their annual report of 2022. There was a delay in that report, and that caused massive, massive fear among the people, right? So right after the next day, their Credit Suisse stock price, it started to fall down, and by March 16, Credit Suisse, they request to the regulator that okay, they need some emergency support for the funds. That's what they requested. But March 18, so there was a plan with CMG for bail-in. So ideally, the situation actually worsened for the Credit Suisse by March 14. And if you look at the timeline, within just almost a week, Credit Suisse was acquired by UBS, right? Because within a week, they have to arrange everything so that financial stability, people's confidence, people's money, taxpayers' money, everything is that needed to be addressed and need to be saved. So within this particular time frame, everything happened, right? So March 14 was a day they delayed in the annual report and stock price falls down. They requested money, but this was a temporary solution. Then they wanted more money. So by March 18, the regulators, FINMA, they actually planned for a long-term solution for it, and a private sale was mandated by the government, which is the regulator, FINMA. So that was the scenario here. Now let's try to read it. I think it would make much more sense. So Credit Suisse, which was a GSIB, globally systemically important bank, they faced mounting operational and governance issues throughout the 2022. There was multiple scandals, executive change or turnover, poor performance, investor confidence was falling down. In August 2022, as I said, ratings downgraded led to several client outflows. People just did not trust at that point in time, especially from wealth management and institutional clients. So that's institutional clients are huge. They if they are there, that denotes confidence in the company. But if they're not, the confidence falls down. Social media further intensified solvency concern. So, what was the initial response in 2022? Of course, as I said, they had 180% liquidity to cover their expenses. So that delayed the central bank support they did not require at that point in time because they almost had two times the money. But the next year, which is March 2023, following SVB failure, Credit Suisse suffered renewed outflows. A delayed 2022 report that, you know, that drove panic into the people's mind. People worried about their own money. So that was a main March was a major date for Credit Suisse. So, what was the response from the regulators? What they actually did? So, it's Credit Suisse, it's a Switzerland's bank. So, Swiss National Bank, they had to step in, they had to intervene. So, Swiss regulator, which is FINMA, they coordinated with a particular group, which is Crisis Management Group, and also the US SEC, right? Because the Credit Suisse has branches in the US as well. They've given bonds in the US as well. So the SEC of the US had to also be associated within this particular situation. And this comprising key international supervisors. So why all these coordinators or regulators they got associated? Because they wanted to prepare a formal resolution strategy under global standards. That was the main objective. Now, what was the thought process or the theme of this particular framework? This is very important. Okay, the framework aimed to avoid disruption, absolutely, minimize contagious effect, and protect financial stability. That was a major theme that they want to focus on. So they had three choices. The regulators, they had three choices. The first one was a full resolution. That means bail in of bondholders and shareholders. That means you pump in the money, you bail in of bondholders, like let the bondholders know that okay, the it's not valuable, maybe convert them into equity and let the equity holders face the loss, because that's how it works, right? You invest in a company that is going to, if that company goes bankrupt, of course you are the creditors and you stand last in the line. You get some money, you get some money, otherwise it's that's how it works, right? But a bailout was a second option, wherein it's called as nationalization, which means the government would step in, they would put the taxpayers' money into the bank, and that's how they will get the money, right? The much needed money. So this was the second option. But the third option that the FINMA, the regulator, actually chose was a private sector merger. That means let another bank buy the share of Credit Suisse. And this was actually chosen. Okay, so this was the thing that they actually chose. So on March 15th, what happened was that the Swiss National Bank, they initially provided 50 billion Swiss francs in emergency liquidity to Credit Suisse. Why? To stabilize them. However, regulators sought a long term solution, because also in August 2022, if you realize, they had liquidity coverage ratio, but still a lot of institutional investors, they went they quit the Credit Suisse. They provided $50 billion, 50 billion Swiss francs, but again they wanted a long term solution to this. So within just a week, the UBS acquired Credit Suisse in a government mandated sale. Okay, so that was a final long term solution for the Credit Suisse. And what are the things that happened on this day? Let's try to read it out. So Credit Suisse shareholders received $3 billion in the UBS shares. So all the shareholders, they got into that. The Swiss government provided UBS with 9 billion Swiss francs as a second loss guarantee. Let the first losses be there, and whatever the second loss, the regulators will provide to the UBS for potential Credit Suisse related. SNB extended additional liquidity support of 200 billion Swiss franc to Credit Suisse, or basically the UBS. 16 billion Swiss franc of Credit Suisse, 81 bonds were written off. Now, this is very crucial. Usually, what happens is that the shareholders, the equity shareholders, they take all the losses. In this case, okay, which I have highlighted here, that this is the important point. Basically, additional tier 1 bonds, they wiped out. They told the bondholders, the investors, that okay, we'll not give you any money. The company is busted and it's just gone. So that's how this was something that was unheard of, because there is a hierarchy, right? I mean, everywhere there is a hierarchy, but this was a situation that hierarchy was not followed. Even before the shareholders, they get the least amount of money, they were given the UBS share, that okay, you get that share, and eventually or basically UBS acquires it, any either way that you say. Bondholders, which comes second in the hierarchy, they were wiped off initially, which should not have been done. So this was a major thing that in this particular case, what happened. So between March and August 2 2023, now everything was resolved until this point, but again they had a backstop or a facility of 200 billion Swiss franc. So between March and August 2023, UBS terminated the public liquidity backstop. They terminated that. They said we don't need it, and that's how it actually went. So that was a case of the UBS and the regulator intervention. So, what was the implication for this? The bail in framework was ready but unused due to fears of market stability. They had all the bail ins, right? They could have told the bondholders or the shareholders, but they wanted to prevent that market confidence. The chosen merger route avoided disorderly collapse and stabilized confidence among the people. Although the deviation from the standard, that hierarchy that needs to be followed, that raised concerns about future predictability, whether the bondholders will get their money or will not get the money as compared to shareholders. That raised concerns, and of course it raised fairness concern as well. So that was the first learning objective. Now, Evaluate the US bank failures of 2023 and their implications for the international resolution framework. Now, what we have in this, we're going to be just, it's just a evaluation kind of a learning objective, just know about it. So there was a case study of the SVB that was the topic last year, but this year we just have to know in brief. SVB with $209 billion in assets failed due to poor risk management, concentrated deposits, like they, all the venture capital money, right? They'll not keep less amount of money. They will have millions and millions of dollars. So all their clients was venture capitals and huge IT companies. So they had concentrated deposits, and mostly this was uninsured, right? And of course, interest rate risk played a massive role in their failure as well. So what happened to SVB? It had strong ties to venture capital firms, grew rapidly from $209 billion by 2022. So within just 4 years, it grew massively. So there was a massive growth in deposits. On March 8, 2023, it sold bonds at $1.8 billion loss due to the interest rate risk. Interest rate went up, their prices falls down, and they had to sell it at a loss. This loss of selling the bonds, okay, why? Because they wanted to have money. That triggered mass withdrawals. Especially people on the internet started to text about it, and due to the internet facility like net banking and so on and so forth, people started to withdraw money like anything. Just imagine $40 billion was withdrawn in just one day. Can you imagine the intensity? So, leading to FDIC intervention and receivership, they received money on March 10, 2023. But in this case, shareholders and most unsecured creditors took losses. That's what I was talking about, the hierarchy of the investors. Obviously, the shareholders would take the loss. But again, we also have another SVB in the UK at that point in time. So SVB's UK arm faced a 30% deposit run in just one day. Okay, so regulators, what they did, they opted for insolvency, let the bank go bankrupt, and sold the bank to HSBC for £1. Okay, wiping out the bonds, the capital, and everything that they had. Then we also had another crisis that was a First Republic Bank. 70% uninsured deposits. Obviously, when the deposits are uninsured, this, people will obviously worry about the money. The bank also failed amid liquidity stress and market fears. So, again, on May 1st, it was sold to JP Morgan Chase. That was a takeaway that we have for First Republic Bank. Again, there was a Signature Bank just right the next day of the SVB, closed on March 12 after a similar deposit run. Why? High concentration of uninsured deposits. So you see that the major takeaway is that there were a lot of uninsured deposits, uninsured deposits. So that was a major implication. And that's why, if you look here, implication for international resolution, when you prepare a resolution framework, make sure that you take care of the uninsured deposits. Why? Because all these crises, it revealed how uninsured deposits and business model risk, it increases that fragility of a bank, right? That's the first thing. It also demonstrated, all the US bank failures demonstrated that even non GSIBs, some bank which is not even systemically important, can become systemically important very quickly. That was a takeaway. Also, the FDIC, they avoided taxpayer losses but incurred high cost. So they gave $14.2 billion to SVB and $1.6 billion, raising future moral hazard concerns, right? That's how it actually goes there. So that was a takeaway for the US lessons that we have. Now, describe the uncovered issues for bank resolution. What are the issues that we have? So what I've done is that I've taken the 96D, the learning objective 96D first, and then I'll take the lessons that we have it. So let me just take it this way. I just designed it so that's to save on some page. Let's go uh, learning objective wise. So, learning objective 96C, identify and describe the strength and weakness of the resolution framework via two cases: Credit Suisse case and the US bank failures. All these two cases that I've brought here. Now, let's get first try to understand the Credit Suisse case and compare it to their strength versus the weakness. I've tried it to have it as a closed view, but let's see how it falls. So the strength of a Credit Suisse, if you look at it, the regulator, they had a GSIB resolution plan using the TLAC, the 81 bonds I was talking about, and the bail-in tools like let the creditors, let the shareholders take that particular loss because it is assumed that they will take the loss. However, they were worried that if this thing happens, there's going to be a contagion risk. Even partial bail in raised market panic and deposit runs. So that would lead to system wide risk. So that was a weakness. Rapid execution. Obviously, resolution could be implemented in 5 days. If you just look here, you would realize that within just 5 days, they actually, this thing happens within just 5 days. UBS acquired. Otherwise, mergers and acquisition takes a lot of time. But this was one of the strength that all the regulators, international regulators, stepped in and they did that. So that was something which was good. However, market confidence was liquidity alone wasn't enough. Government assurances were critical. So it's just that to have that market confidence, liquidity is just not enough, and that's why they had to go for a acquisition. That was the thing that we had. International coordination, absolutely. We have seen that the SEC, CMG, other regulators, they all coordinated. There was a transparency as well. Early CMG involvement and regular communication helped support market trust. Just imagine something is happening in Switzerland and you have to coordinate in the US as well, right? In the probably in Europe as well, so on and so forth. So there was a lot of transparency, coordination, which were all the good things that we saw in this particular resolution framework that we had. There was a Asia Pacific engagement as well. Coordination with APAC region supervisors ensured a global message, right? So that was the strength of the Credit Suisse. As I said, weakness was that obviously they wanted to prevent that contagious risk, market confidence. They don't want to lose in that. Hence, they chose that third option, which was a merger. Resolution complexity, authorities were hesitant due to fears of worsening the too big to fail problem with the UBS takeover. So they had this complexity and they don't want to send out a message that even a bank like Credit Suisse, which is a large bank, they don't want to give that perception that okay, it's too big to fail. No, they don't want to save on that particular thing. They should have let that. But again, that's a weakness, right? Otherwise, Credit Suisse, if that fails, we can say that okay, even two big banks can fail. That's what the thought process here is. Communication challenges required real-time updates across jurisdiction and time zones. There was some communication challenges. I mean, Switzerland here, US there, right? So obviously there was a communication challenges. Legal barriers, of course, US securities laws are different, right? As you see that in those US cases, you would have realized that they chose let the creditors take the loss, not the not a merger or anything in the SVB case. So their differentiation was also there. So these are some of the weakness that we have it here. Now, if you compare it to the US bank failures, if you look at the strength, there was an advance preparation. FDIC had resolution plans, they had tested plans. Bridge banks, like in between, someone would acquire like that. They also had these structures ready. That's the US bank failure strength. Successful cross-border cooperation. FDIC worked with CMG, FSB, that is in the UK, Financial Standard Boards, Bank of England for the SVB UK. So they coordinated all these things. Are the good things when there is a resolution for that. But it had many weaknesses. So first of all, they could not control about the rapid growth risk. SVB within 4 years grow from, I think, $50 billion to $200 billion. That's four times, right? So they have changed their non-systemic to systemic very quickly. So they could not figure that out. That was one of the weakness in this kind of a approach. Business model fragility. The regulators should be able to understand high concentration risk within that particular bank, and especially uninsured deposits. If they have a lot of uninsured deposits, highly concentrated, if those clients go out of the bank, they'll have no money left, right? So this is something that was a weakness. Lack of long term debt. As I said, regional banks lacked sufficient loss absorbing capacity ahead of depositors. Depositors are short term, right? They can demand their money anytime. So there's a long term debt, the money that the bank needs. If it is short term, people will take it out immediately. That's again a weakness. Digital bank run, as I said, you can take out your money, you can transfer your money very quickly from one bank to another, and that's a bank run digitally. That's again a weakness. Confidence challenges. Even post resolution, counterparties hesitated to trust bridge banks. And this was also true because even after the money was provided, everything was provided, the counterparties, they were reluctant to trade with the banks, the bridge banks, basically the someone who acquired. But the regulators, they said that, okay, do not worry about it, trade with them, because if they do not trade, market will perceive it to be in a different situation. So that was a confidence challenge as well. Systemic spillover. Failure of non-GSB had broad contagion effect, right? SVB led to Credit Suisse. So all this thing happened, there was a systemic spillover. Inflexibility. Regulators had to quickly revise resolution plans under pressure, right? You have to do it. You just have to take a decision. But if there's inflexibility, you cannot do it. Uninsured deposit dominance. High share of uninsured deposits. So this was a major weakness. We all know that uninsured deposit was a major weakness. Okay, now let's go to the last learning objective, which is describe the uncovered issues for bank resolution. What are the uncovered issues for bank resolution that require further studies and development? First is a backstop design. Backstop is like a facility, emergency facility, liquidity facility, any kind of a facility. So, future improvements to the resolution framework, what should be? First is the design of the facility, whatever facility, liquidity that you're providing. Evaluate how the public sector support tools, all the central bank liquidity resolution funds, deposit insurance, all these things, how they are helpful under various scenarios. That is something that you need to develop a plan for. That's the first thing. Secondly, resolution strategy, is it flexible? Regulators must quickly choose between bail in, or a sale, transfer, or any hybrid approaches like bail, transfer, whatever that means. So their flexibility needs to be enhanced further. That's the second thing. It must allow fast pivot to alternative plans. That was something that needs to be there in the future resolution framework. Speed, coordination, and communication. Of course, ex ante announcements improve clarity after happening something, but real time coordination is crucial during a crisis, like crisis management group, SEC, and the FINMA. They all coordinated together, but there needs to be more coordinated efforts. Operationalizing bail-ins, like whenever there is a bail-in happen, right? The creditors, all this thing, cross jurisdictional legal alignment is needed for bail-in execution, including, so basically what it means is that if someone is has let's say a bail-in, let's say the bonds has been converted into equity. Now the bondholders become equity holders, they share the losses. So there should be some operational efficiency, or legality should be there, so that the bondholders, Basically, the law, the compliance, all these things or rules should be there, that okay, the bond holders can be converted into, let's say, the shareholders. So all these things should be there. Whenever there is a bail in, there should be operational efficiency, like we can convert it quickly from bonds to shareholders. That's the entire takeaway for future resolution, right? That's what we have it here. Restructuring phase oversight. What do we mean by this is that a credible plan post resolution must restore long term solution and investor confidence. So there should be, all the things are done, bail in, bail out, whatever the plan is done, long term solution should be done, or resolution should be done for the bank. Resolution planning for non GSIB, as we have seen in SVB, it was a non GSIB, but within just few years, it became SIB, as good as SIB, right? So authorities must assess which banks, even if not GSIB, can pose system wide risk. That's what we need to consider, and require them to hold TLAC instrument that can be converted from bonds to shareholders. And of course, deposit insurance, there needs to be reform in this particular thing. Striking a balance between protecting depositors and avoiding moral hazard is critical. So insurance must be credible, limited, and comprehensive to protect or to prevent panic. This was the entire takeaway for this particular chapter. All right. So if you have any doubts, you please feel free to ask now. Right. So the next chapter is chapter number 2, which is generative artificial intelligence in finance. What are the risk consideration when we talk about the generative artificial intelligence? Here we're talking about what is Gen AI or generative AI. So let's try to understand what do we mean by Gen AI. So let me just zoom in a little here. So a Gen AI is basically, it's a technique that learn from data about missing things and use this to generate new artifacts. So basically, generative AI, I think the best example is that of Chat GPT. Gen AI is basically like Chat GPT, wherein you give prompt, it can help you to create more than just what traditional AI does. So what does traditional AI do? Traditional AI is just a simple one thing task that you let it know. Like for example, you are getting a lot of emails, so you want to give it a task to the traditional AI that okay, which one is a spam email, which one is a not spam email, and it just falls. It just does this simple task of identifying which is spam or which is not spam. Okay, so it's a traditional AI is like a voice assistant where it can only perform one task that has been pre-designed. That's what the traditional AI does. But Gen AI, it takes it to the next level. You can say that, okay, create images, create videos, create a lot of things via giving the prompt. So that's what generative, it generates a lot of things. That is what we mean by generative AI. Okay, so it uses a lot of large machine learning models. It learns from the data, and it also uses the large language models that is trained on vast amount of tests to interpret and generalize human like uh, outputs. That's what it actually does. And ChatGPT is a prime example of generative AI. Okay, so that's what we mean by generative AI, something that uses prompt and produces output that you actually need as per your situation. So if you look at the AI adoption that is happening, yes, it is happening in finance, and it enhances financial accuracy. It strengthens compliance and risk management. So for compliance also, you use this. It improves client interactions and reduces cost, obviously, and improves efficiency. So all the best benefits that you have, not just in the financial world, even in the cyber security. It enhances incident response, enables predictive threat detection. So for cybersecurity, it is useful as well. And overall benefit on the financial sector is that the customer is happy. They get better service. They operational efficiency, cost, everything is down. Operational efficiency goes up, risk mitigation and compliance improvements, all the basics that the AI helps us. What are the challenges the generative AI system pose for the financial sector, including that related to data privacy, embedded bias, model robustness, and explainability? So, obviously, if you think about generative AI, it is built by using data. If there is no data, it will not be able to produce anything, right? So, data is very crucial. So, obviously, when we talk about data, is the data secured? That is a very first challenge of generative AI. That is data privacy. Is the data that we feed in, because let's say you want to create something and you put in some information, is that data secured? That's the very first thing that will come into your mind. So, major challenge of generative AI is data privacy. Specifically, so if you want to understand the Gen AI risk, there could be a leakage of a data, some financial sensitive information or personal data that could be leaked. That's one risk. Unmasking anonymous data. So maybe you want to enter your social security number or any private information that could be unmasked, right? If there were like stars or the asterisk, that could be unmasked. That is another risk of generative AI. So even with enterprise level controls, using broad internet datasets may unintentionally capture private information without your approval. Remembering individual information, that could also, you don't want your any number to be remembered, but what if it does remember or store that? That's another risk of Gen AI. Users may unknowingly input confidential data into public Gen AI tools, compounding the privacy risk. So that is something that we have it here. Okay, moving on to the next particular risk as per the learning objective, and that is the embedded bias. Basically, what happens is that, as I said, data is very crucial, right? If this data that you have, if there's a bias already included in this data, obviously the output that you will get will also be biased, right? Something that you don't want. So, whenever you feed the data into your model, make sure that there is no bias in it. Now, what do you mean by embedded bias? That means, let's take this example. There are candidates who are screened for the interview, right? And there are a lot of male candidates and only a few female candidates. Now, obviously, you input this training data into the model for recruitment purposes, right? You have inputted the model here, and obviously, the output that you would get, this would be more biased, and this would lead to more male candidates being selected as against the female candidates, right? Because there was only a handful of female candidates and majority information was of male candidates. So this is a clear case of an embedded bias. Maybe similarly, you if you just feed a lot of information or for credit scores, let's say for loan approvals, right? You just feed a lot of people with best credit history and everything, and only a handful of something which is on the average, right? On the borderline or just above the borderline. So obviously the output that you will get will be biased. It will just try to reject the loans as soon as it reaches that borderline kind of a situation. That is what it would actually lead to. Yeah, so I'll answer the question later. Just give me 1 minute. All right, so that's the embedded bias that we have it here. All right, so Gen AI models inherit biases from training data. Whatever data that you feed, it will produce those outcomes. This can lead to discriminatory risk profiling or client assessment. That's a problem. Future risks are amplified by SEO optimized content. when you create those SEO things, you put in a lot of keywords. If you put in negative keywords, all the negative keywords, think about any negative: stock market crash, uh, not good company, bad company, all the other things that you can think of. If those keywords are picked up by the Gen AI model and it trains on that, obviously the output would be producing more bias data into the Gen AI models, right? So that is something that is going to be a challenge here. So that's something that we need to do. Okay, that's the embedded bias that we have. The next thing is model robustness. Now, what do we mean by model robustness? It refers to how stable and reliable AI systems are in various environments. That's robust. Is the model working in different situations? However, Gen AI models are sometimes prone to hallucinations. What do you mean by that? That means it will give you certain output which is incorrect, but it will say that it is correct. It will give you all the logic that okay, that this particular thing is correct, even though we know that it's incorrect. So this poses serious risk in financial services where consumers might receive incorrect advice, incorrect product recommendations, or where risk assessment could be based on inaccurate information. Let's say you are a risk manager, it tells you that okay, the VAR has not been exceeded, but in reality the VAR has exceeded. So the model has just produced, a model is just hallucinating, right? That's what the meaning here is. And if when we talk about the robustness, reliability of a model, we need the models become less reliable during periods of structural market shift. Obviously, the structure happens, right? The sometimes there's a recession, a boom, recession. So all this structure goes like this. So if the model has been trained only in this uptrend, it will not be able to pick the downtrend. Again, if there is a downtrend, the model will say that no, 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 buy this share. Again, it's going to go up because it has been trained on only up moves. So that structural shift, whenever there is the structure that has been shifted from up to down, let's suppose this, then in that situation, the models become less reliable. So we need to understand that. We need to make sure that we, go ahead with like this. What is explainability? Explainability here refers that it is extremely difficult to understand and trace how Gen AI outputs are derived from inputs. You are a manager, you've used any kind of AI model. How will you explain it to the management that, okay, this is the output, you got it, but how has it been done? That explainability factor is really important, right? So there are a lot of complex model architecture. It's really hard to understand those things. So what it leads to is that it hinders financial institutions ability to explain their decision to stakeholders. You're not able to explain that that intuition that is missing. So that's what the point is. Hence, final decisions should remain with humans who can understand and explain the reasoning behind what actions. If you're buying, selling a stock, holding a stock, explainability is very, very important. All right, moving to the next learning objective, explain the use of synthetic data to enhance AI model and the potential risk associated with synthetic data. Now, obviously, data is really, really important when it comes to Gen AI. The data needs to be fed to the model. Now, what is the concept of a synthetic data? We know that the data has data privacy issue, there can be bias, there can be explainability challenge, a lot of other things, right? Why not we have an artificial data so that we avoid this biasness, imbalances, right? And we'll have more and more data for more AI training for future models. So that is where you get this concept of a synthetic data. So I'll just give you an example. Let's suppose we have a bank here, they want to analyze the credit risk profiles. What they do is that first they create some typical credit risk profile ranges. Okay, like say that the first would be like they have an income of, let's say, random people. with $40,000 to $120,000. So this is a range that they put for all the like 41, 42, 43, all the incomes. Then they create loans for all the different range, 5,000, 6,000, up to $500,000. Then they have a credit score range, 600, 700, 601, all the other ranges. They create all this profile and they put it in the, they put it in this AI algorithm. They run this particular thing and it provides a synthetic responses, synthetic data that you get, right? With like, for example, this particular customer with income of $100,000 will take for $400,000 loan with a credit score of this. So what is the response should be? So basically, using some typical ranges, you put that into the model and it will generate some data for you. This is known as a synthetic data, artificially created data. So synthetic data, it is created by algorithms generated to mimic real data, mainly used to train and test AI ML models. It is cost effective, avoids privacy concern, and isn't tied to real individuals. So good to go. Helps reduce bias imbalances found in real world data. In finance, it is used for fraud detection, compliance, reporting, product development, and training for AI models. That's what we use it for. However, there are certain risks with the synthetic data. It may still replicate bias or gaps from the original data. Again, you are inputting the data, it can still have those biases. There can be poorly generated synthetic data may reduce model accuracy and reliability. Maybe it is useless thing that it produces. Financial institutions may be unaware of hidden risk in AI training due to data generation complexity. It's not easy to have that data, right? That's why data is all about that is there in the Gen AI. Finally, evaluate the cybersecurity threats and potential impact on financial stability posed by the use of Gen AI in the financial sector. Let's suppose that we are introducing Gen AI in the finance. What's going to happen? Very, very, without even thinking, cybersecurity, right? There can be a lot of within cybersecurity threats. There could be like impersonation, fraud. Anyone can make a video for anyone and just impersonate fake identities. That's first risk in finance. Phishing attacks, convincing emails increase cyber threats. Very convincing emails, like a hallucinated email, but just to gain access to a to the customer, like that, that's a phishing attacks. Deep fakes, AI generated content manipulates the market. They can offer a tip or something for the stock market, buying, selling. That's a deep fake. That's again a risk of Gen AI. Gen AI systems are vulnerable to input attacks. Now obviously, as I said, data is really important in the generative AI models. So there could be a input attack. That means during this training phase, the data could be manipulated. That's an input attack. Data poisoning, just to change the behavior of the data, the ranges of the data. Data poisoning. Data manipulation via AI generated content or SEO keywords, that could also be happened. See, everything is related to data. And finally, there could be a jailbreak attack. That means prompt injections that bypass AI filters. So there are certain things that ChatGPT, by legality, let's say that they are not able to produce that. But the hackers, what they'll do is they'll try to give those kind of prompt that will bypass those legalities, right? In a different way, they'll ask. So extracting sensitive data, that is the main motto. So there could be a jailbreak attack as well. So Gen AI systems are vulnerable to all these things that we have. And specific to finance, if we talk about it, Gen AI risk in finance, there could be a cybersecurity risk. Gen AI can create fake, malicious content, increasing cyber attack. Very important, cybersecurity. Liquidity, solvency, profit focused AI trades may neglect risk, causing instability. So, if you have created an algorithm just for selecting the best stock to buy, even though it's not recommended to buy that stock, but your AI model is saying that okay, you need to buy, and you send all to the people that okay, buy this stock. That's a bad thing, right? So that can cause liquidity issues to the customers. So that's what the point is. Herding and mispricing. AI generated reports may amplify herd behavior and pricing errors. Obviously, the data is surrounding on the internet. If the AI model learns from the internet and someone has posted that buy this stock, sell this stock, it will produce herd behavior. It will just follow that particular thing. So that could also be a problem. And hallucination, right? Inaccurate outputs can mislead markets if widely adopted. If that answer, which is incorrect, but the AI says that no, it's correct, that can lead to misleading the markets and systemic risk. Note, while Gen AI improves efficiency, decision making, yes, it does help. Regulatory oversight and human intervention are vital to manage these risks. Okay, so this is what we have it here for this particular chapter. You have any question, feel free to ask. And there was just one question that was being asked here. Let me just take that. uh, Regarding banks failure, do we need to be aware of the events which inter alia led to failure, for example scandals? And no, 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 we don't have to get into it. See, remember, what happened is that this is a 2023 failure. It has just been released for now for the resolution purposes. Like what resolutions were taken, was what was the strength of the resolution, what was the failure of resolution. So it's like we are learning from that. That is the entire takeaway from this particular chapter. We don't even have to remember the exact timelines, but just know it for the exam purposes. March 14th, and this is just for our benefit, nothing else. So you don't have to get into the what scandal that happened in the Credit Suisse scenario. Just know what happened, when it happened, what was the action that was taken, the resolution, and strength of the resolution, weakness of the resolution, and what could be done better for future. That's what the chapter is all about. Even this SVB, they had a chapter last year, so not to focus much heavily on this particular thing. But again, there are 9 chapters that you have here, so one question can be expected from each chapter. That's what we've been seeing in May. So chapter number 98, which is the artificial intelligence and the economy. So here, what we are looking out for is the implications for the central banks. That is the core objective that we have it here. So this year, I would say that current issues, there are 2 chapters from AI. The chapter number 2, which was the previous one, and this is chapter number 3, or reading 98. It talks about the AI. Here, I think if I compare it with the last year AI, that was pretty much abstract. Here, it's very interesting and something on the new things as well. So I think it's better. So we can definitely score maximum marks in current issues. Okay, this is an area that has a huge, uh, potential to score the maximum. That's what I'll say. So identify and describe the risk arising from widespread use of AI applications in the financial sector. So let's talk about this first. So essentially, when I talk about the AI opportunities and the challenges in the financial sector, you just need to remember this table for the exam. Okay, you do not have to remember each and everything, but just know this particular table, and I think that would be good to go. So the general opportunities and the general challenges, let's talk about this. So if I talk about the general opportunities in the 4 different financial sector that we are talking about, let's talk about payments, credit assessment and lending. Then you have the insurance and the asset management. So if I talk about the general opportunities, obviously, if you think about it, there's going to be lower cost, there's going to be better productivity, in compliance, regulatory compliance, fraud detection, in all these payments, assessment of credit, insurance, asset management. It's very much helpful when with these general opportunities in these four sectors. You also have a virtual assistant that can work in the payments, credit assessment as well. Co-pilots, a lot of people use Copilot as an assistant, backend processing. So a lot of things that AI can do in these general opportunities that it presents for these four sectors that we have here. The next is obviously the specific to each industry. If I talk about the specific for the payments, obviously you want the payments to follow that anti-money laundering, uh, a process where people do not, do some sort of an illegal activities. So AI can be helpful in having that or preventing money laundering. So anti-money laundering, it's a very uh, good thing for payments industry. Know your customer, liquidity management, very fantastic when it comes to AI. If I talk about credit assessment, when you want to assess the customer for loans, you can have financial inclusion or exclusion, right? So better inclusion is the what we are looking out for. Credit risk analysis can be done in a better way. With large amount of data, you can analyze it. If I talk about insurance, yes, claims, like you can use the AI to take a photo of the vehicle or anything, just put it on that particular app, the AI will assess. So a lot of industries are using the insurance for claims settlement, so that gives faster settlements. Risk assessment, that could also be done. If I talk about asset management, yes, a lot of AI is being used for algorithmic trading, where algorithms are run and that tells you whether to buy, hold, or sell a particular stock. Robo advising, like a robot, it advises you about the changes in the investment industry. Portfolio allocation can also be done using AI, and asset embeddings, any derivatives or any kind of things that are embedded onto a particular asset, you can actually use AI for that as well, for specific assets. So these are the general opportunities and the specific opportunities that we have. Now let's talk about the challenges when it comes to the all the four industries in common. Obviously, the very biggest challenge is cybersecurity risk. You're using AI, internet, cybersecurity. Hallucinations, you may get some output which sound to be true, but it's not. Data silos, all your data will be in one particular server, one particular unit or something like that. That could be a challenge. Third party vendor dependency could be one of the things. Explainability, maybe you get that output but you're not able to explain it to the supervisor for better reasoning. That could be a challenge. And algorithms can clash. That could be another specific thing that we may have. So, what are the specific challenges? Specific, if I talk about it, cyber attacks and fraud, liquidity crisis, these are the specifics. There could be, if I talk about in the credit assessment and lending, there could be privacy concerns, algorithmic discrimination. That could be the credit assessment for specifically to either the insurance as well, your privacy, your details, personal details can be used. Algorithmic discrimination in the insurance, let's say it shows damaged, but AI is not able to read that. That could be a challenge as well. And of course, herding, a lot of herd behavior, a lot of people follow the same algorithm, a lot of people follow the same behavior. It throws the same output. That could be an example of herding. Algorithmic coordination, race for private gains, and it just shows that kind of a algorithm or an output. That is an asset management. Financial stability challenges, yes, this is one of the things that could lead to financial stability overall. So again, that is of herding, single point of failure, incorrect decisions due to non-representative data, real sector spillovers, network pro-cyclicality, and interconnectedness. See, everything is interconnected in certain way. One risk can have within the, let's say, insurance, that can lead to effects in the overall financial stability or instability, I would say that. So basically, all you need to do, remember, for the exam is just to know about all these things. You do not have to necessarily remember each things. That's just use little logic on the exam, what sounds good and what does not sound to be good. And I think that's going to be the answer when we have this. Okay, moving on to the new cyber risk. That So within the cyber risk category, there are two things here, which is a prompt injection attack, which is like the input. So we know that it's really important in the AI that the any model or any outcome or anything, data is really crucial, right? So if you have a in prompt injection attack, what do you mean by that? Is that inputs created to cause unintended behaviors in the model. So if the data is attacked in such a way that the behavior of the model is not good, like it's something it should not show, it does show that. So that's prompt injection attack. There could be data poisoning attack as well, which is malicious tampering of AI model training data. Here you do it, so obviously the output will be faulty. And model poisoning is training process manipulation. So within this process that you have, you follow that particular thing, that's how it's manipulated. That's a data model poisoning. Just good to know information. Okay, you do not have to necessarily remember it, but know it. Okay, at least this much, know it for the exam. All right, moving to the next particular learning objective, it says describe how central banks can harness AI to fulfill their policy objectives. Now what it tells us is that how the central banks can use AI for their policies objectives. Well, there are certain ways that they can actually do it. So there are several strategic ways that central banks can use AI to fulfill their core policy objectives of maintaining. Now, what are their objectives? Maintaining economic and financial stability. That's the first objective. Price stability, second one, and overseeing the financial system. That's their core objectives. How can they use that? Well, there are certain things that they have actually created. I would say that there are almost like seven, eight, nine kind of projects that that central banks have actually, in coordination, they're actually creating that. But out of that, for the exam, we just need to remember two projects. So there are major projects supporting the AI use within the central banks, but two critical projects that we will look at. First is the Project Aurora, which is led by the BIS Innovation Hub. It demonstrates how machine learning can be used to outperform traditional rule-based system in detecting financial crimes like smurfing and mule accounts. Remember this, Project Aurora is used for anti-money laundering. That is what it is actually used for, right? So that people do not have multiple accounts and multiple channels of transferring the money and for illegal activities like smurfing and mule accounts. So this project improves cross border anti money laundering detection. Okay, that's the usage of Project Aurora. Remember this thing, Project Aurora for anti money laundering. The other project that we have is Project Agora. Now what it does is that it involves seven central banks. So you can imagine central banks are using this, right? Seven, and private sector participants as well. What it does is that, let's say that here we have a pair in a one country, let's say A, and here we have another customer or any person in country B. He's a pay. So he wants to send the payment from one country to another. Now what usually happens is that usually the payer will go to the bank, they'll go to the payment system that they have, then it goes to the central bank, or in this case it is the correspondent bank in country A. Then the correspondence bank, which is a mediator, here it transfers to another country's correspondent bank, it goes to the payment system, and then it goes to the bank. But let's say the information check here fails in this particular scenario. Then what happens? Will the payee receive the money? No, the payment is not processed. So what Project Agora, what it does is that seven central banks, if you look here, there is a role of central banks in this Project Agora. What it does is that it takes tokenized deposits and central bank money into a single platform. Now look what happens when we have Project Agora. So here the pay, what it does is that, so he goes to the bank. There's a central bank here. The pay, there's a bank, there's a central bank here, and then there is a this correspondent bank. So there is inbuilt payment system among those seven central banks that allows quick money transfer in a better way. Okay, that's a tokenized, and all this thing is integrated. So that is what the project Agora actually does. So just need to remember, it's using of a technology which is what we call as a finternet. I would say that, remember this term, which is finternet. It's a network of interconnected financial systems using ledgers and tokens to enhance service quality and access. So what is finternet? Finternet is nothing but a project that could be, Project Agora could be a great example for finternet. Okay, so that is what we have it here. By doing so, the platform will be able to execute payments atomically, combine account and messaging updates into one single integrate operation, and use privacy preserving resources for anti money laundering, KYC. Everything would be done automatically. So that's what the Project Agora actually means. Now, uh, as I said, the BIS has created 8 projects, AI projects, supporting the central banks, aligning news entities, supervisory like Ellipse, extracting climate data from ESG reports, which is known as this, analyzing supply chain dependency for the economy. You know, supply chain is very important to understand the economic supply, demand, and all these things. So that's project name is Insight, and building economic indicators, which is Neo. So these are the things, but we just need to remember two things: Project Aurora for anti-money laundering, and Project Agora, which is for this payment uh, using the technology of internet. That's what we need to remember. Well, if I talk about those projects, apart from that, there are certain specialized AI applications as well. As I said, Finternet, I've already explained that. Now, casting, what it does is that it uses real time data to produce economic forecast in real time. That's what now casting is all about. AI models convert the unstructured text and images. So all the unstructured data, it just converts that into, good information in real time. So you don't have to wait for it. Enhancing the accuracy in tracking investments, consumption, and supply chain disruptions. However, it requires high quality real time data, making implementation complex. So that's what nowcasting means. Inflation analysis, well, central banks use AI to analyze the inflation drivers as well, to understand, just know about this, to understand past patterns, expectation, international prices across the world, and the output gap, the output, basically the GDP, right? Uh, Financial stability analysis. So these are the good to know information. AI helps identify patterns and risk across large data sets in both financial and non-financial firms. Macro prudential, like for they use Gen AI with human input, can detect early vulnerabilities and imbalances before they escalate into major issues. So just for macro prudential regulation, that is what we have it here. But just good to know information. Okay, this was. Okay, the next learning objective talks about the explain the macroeconomic impact of AI. So, what are the macroeconomic impacts of AI on the macroeconomy? Well, obviously, the productive capacity has increased. AI improves firms' output. You're able to do tasks very easily, quickly. So, obviously, the productivity increases, especially the workers' knowledge have increased, like writers, bloggers, support agents, coders, So, obviously, high productivity, higher GDP, higher income. As simple as that. Investment, if I talk about it, higher productivity obviously demands the aggregate demand. Obviously, I consume more data, you consume more data, everyone is consuming data, right? So there's going to be higher use of the investment as well. Firms are investing significantly in IT and AI integration across business operations. So a lot of investments is coming in as well. Productivity of the labor, AI increases labor demand overall, but impacts vary. So for example, this is quite uh, it's good to know statement. I would say that routine jobs may be displaced, they may be out of jobs, like which is a routine work. However, there's going to be a difference between someone who's skilled and unskilled. If someone is unskilled, doesn't know how to use the AI, or perhaps is doing the routine job, perhaps they can lose a job. And someone who's skilled can actually take this opportunity, and obviously the inequality between the skilled versus the unskilled will just widen. That's what the impact on labor productivity is. So it depends. Economic output, if you think about it, AI driven gains in productivity raise aggregate supply. So there are a lot of AI tools, don't you think so? There's Chat GPT, there's Gemini, there's a lot of other like DeepSeek, so on and so forth. So obviously, similarly, the productivity has increased a lot, and supply has gone up. At the same time, investment and consumption push aggregate demand, leading to higher overall output. So everyone is using, someone is using this, someone is using that. So there's overall economic demand. Supply is there, demand has to go up to meet to it, right? Otherwise, there's going to be an imbalance. So that's the overall economic effect. What about the household consumption? See, AI reduces search frictions. You want to buy something, you just take your phone and you can buy it very quickly, right? So the search friction definitely has gone down. You want to buy anything, you go to Amazon, Flipkart, and you can buy anything, right? Helping consumers find products and services more easily. And that's how you spend money, you boost your own consumption. However, its impact depends on labor market jobs. If people are losing job, they do not have money to spend, spending goes down. So obviously the price or the demand will go down, price will go down, like that, all these things, right? Job displacement may lower spending, but at the same time, you go to the employer and say that, okay, no, the world is changing, I want higher wages, I have learned AI, I want higher wage, and employment could increase it. So if someone is earning a higher salary or higher income, obviously they're going to spend more and drive more demand basically. So the overall point is unclear when it comes to the household consumption. Rising inequality from AI adoption may also shift consumption pattern, right? We used to go down to buy stuff, now we don't do that. So pattern is changing, consumption pattern is changing, we are eating healthy food, all the other things that you can just get into it. Okay, but that's the household consumption. What about fiscal sustainability? Obviously, the growth is high. Obviously, the debt will be lower as compared to the GDP. So that's a better thing. So fiscal is also good. However, there are certain risks if interest rates or an unemployment rise. So if the interest rates keep on rising to control the inflation, then obviously there's going to be the interest will be high, a lot of borrowing will become expensive, right? And obviously the unemployment rate, if it does rise, that can also lead to certain other, obviously the government will have to raise more debt to pay for all the services or the government provides. What about the inflation? Now, do not get confused here. Inflation, I would say that there are three effects of inflation. uh, it has the effect in the short term, long term. That's what it basic a thought process is. So if I talk about the inflation effects in the short term, AI may initially reduce inflation if productivity outpaces demand. So if there's a lot of supply as compared to the demand, what do you say? What do you think? If you feel that there's a lot of supply, lot of inventory is there, obviously people will you know reduce the prices to sell to the people. So obviously, if this is prices low, inflation would automatically will be low, right? That's a short term effect. However, for a long term, as capacity, wages, and investment rise, so as everything, like people will demand more salary, people will invest more in the AI technology. Capacity is also increased. Skilled workers demand more money and hence spend more, and hence demand goes up. So if obviously demand goes up, the prices go up and inflation go up. So that's the so if I have to talk about it, I would say that the short term effect is that the inflation is low, but the long term effect is the inflation is high. That's the effect on the inflation. Using the AI for prices, you can actually find the right price. AI driven algorithm pricing may increase price uniformity. You know that, okay, one thing is selling here in for 30,000 rupees. The other app or other platform will also have to sell it for 30,000, right? To stay competitive. So, algorithmic pricing may increase price uniformity and responsiveness, affecting how inflation transmits. So, that can also be used by AI to have that uniformity of price. That's what the point here is. Okay, moving to the last learning objective, explain how the use of AI presents new opportunities, challenges for central banks. Okay, let's look at the AI opportunities and challenges for central banks. Remember, this chapter talks about implications for central banks. This is what it is. So we have to appreciate that the role of a central bank. Why do they use AI in the very first place? Well, they are the users of data. They analyze the data for their policies with AI improving insights. So they are the user of data. They are the compilers of data. They gather data, let's say from RBI gathers from all the banks, from official and commercial sources, for model training. They are the providers of data. They share the data to the banks or to other regulators to promote transparency. So that's the role of central bank. Why do they need AI? Because they use data, they compile data, they provide data. Hence, they need AI for their improvements. That's the use case. What are the opportunities for or of AI for the obviously the central banks? Obviously, the data handling, faster, accurate analysis of financial economic data, very reasonable opportunity that we have. Surveillance, yes, real time oversight like nowcasting of banking systems, markets, you can do that. If you want to implement the policy, you can have improved forecasting and impact assessment. What's going to be the impact of a particular policy? AI can actually help you to predict that policy implementation. Collaboration, yes, there are, the BIS actually encourages that if one country has developed certain things, share, the central banks can have a collaboration, right? There could be a shared platform. As I said, project Agora, there were 7 central banks who were within that particular thing. So that's an collaboration. All the 7 banks are coming together, right? International banks. So that allows pooling of models and resources. And that's the opportunity of using AI within the central banks. But that does include certain challenges as well. Okay, so the risk include the data errors. There's going to be errors in the data, obviously. Hallucination, you're getting output which which like too good to be true. It is true, but the overall, we know that it's not true, right? Cyber threat, this is the biggest challenge. Cyber threats, there could be human capital and staffing issues as well. People should understand, like, okay, we implement the data or the AI, but I need that skilled staff to understand the output or to use that AI for the, for betterment of the data, or how to utilize the data and everything. So I need better talent. But if there's a talent shortage, and the need for human judgment may remain key concerns. There could also be a third challenge, and that could be of a model risk. What do I mean by model risk? Is basically, uh, there are two options that central banks can actually have. The first one is an internal model that they can actually use, and the second one could be the external model. Okay, which is also denoted as off the shelf. Okay, so remember, this off the shelf is nothing but the, uh, like you buy it from a shelf like that. That's an external models. So what are the good things about internal model is that you know the entire process, everything that you know, full transparency. You can customize it to your specific use case. That's what the pros of an internal model. At the same time, if I talk about an external model, is that it has a lower upfront cost. You can take a service of someone else. You don't have to create it, go through the entire process and everything. And it is quick to deploy. The moment you buy it, you can deploy that. What about the negatives of internal model is obviously high development cost. You need people to create it. You need that system, process, a machine, everything that you needed. Skilled staff, right? So you need to hire and create it. Obviously, the external one is a less control. There's not much control that you get. Potentially over reliance on vendors, whatever the third party has provided that particular AI model. I just have to use that. So obviously, if I look at the trade off, like one good thing, one bad thing is that internal models, you have better control, but cost really goes up, right? It's not effective. If I talk about the external models, obviously there's a lot of convenience. I can have better convenience, but transparency is not there. So that's a good thing and a bad thing, or a trade off between the external versus the internal models. And then finally, you can have cyber security vulnerability. This is the most common point that you will see. AI systems introduce new cybersecurity vulnerabilities such as data poisoning, injection attacks, which can compromise data integrity, and you will have model outputs that can be compromised. So, this is what the AI or the implications of AI for the central banks that we have. Okay. Good to know information. Know this first learning objective, read through it, know these three lines, and then just know about these two projects that we have. The technology is the latest one for internet nowcasting inflation. That's it. And what are the AI macroeconomic impacts on productive capacity investment, a household, the impact of inflation, household consumption. So I think it's pretty much not going to be a very challenging chapter, I would say that. Okay, so that is what we have it here. Okay, let's moving on to the next chapter, and that is reading 99, which is interest rate risk management by emerging market economies bank. So it's kind of like a comparison between the advanced economies versus the emerging market economies. How do both these nations, how they manage the interest rate risk for their balance sheet or the banks? Now, before I get into it, I just want to very quickly let you know about a little detail that I think would be very much helpful uh, in order to understand this particular chapter. Just need to know little terms here, which is the interest rate impact. Obviously, this is a EME bank and this is an advanced bank, advanced economy bank. But just let's try to understand a simple balance sheet here. So let's say I have an asset of a particular bank. I have loans which are 1 to 2 year for a business loan, let's say. And this is one differentiation that you will actually see, that EME banks, emerging market economies, they give a very short term duration loans, like 1 year, 2 years, 5 years, like that. As compared to the advanced economy banks, if you look at their balance sheet, you will realize that the loans that they give is almost as good as 20 years, which is a very longer duration. So this is just one of the major difference that you see, EME versus advanced economies bank. And also another difference in the liabilities section, if you see, the deposits that they generally take is usually a time deposit, which is like a 1 year kind of like a fixed deposit. And if you look at the balance sheet of an advanced economy, you realize that they take demand deposits. Like anytime you go to the bank, you can withdraw your money. So there's a huge mismatch. If you realize, the very first difference, if I have to say that, uh, between these two is that the deposits, there's asset liability mismatch, duration mismatch, right? So this is one of the concept that you need to remember. What is a duration matching concept? The duration of loans, which is 20 years, is not matching with the duration of, let's say, demand deposits, which is like 0 day. I can deposit money today, I can withdraw it today, like that. So there's a huge mismatch in the assets liability. That's a duration matching concept. And here, if you look at the duration matching, obviously they give out loans for, let's say, 1 year. They take deposits of, let's say, 1 year. So the asset and liability duration is matched. So they are better able to manage their interest rate risk. But let's look at the interest rate impact. Now, obviously, the interest rate impact, if I have to talk about it, let's say the bank earns 5% on a loan. Okay, so interest that they are receiving is 5%, okay, on all the loans. And the deposits to the customers, they are paying 3%. So the interest paid is 3%. So obviously their net interest margin, or their money that they are actually earning, is 2% on this. However, so what is the interest rate impact if interest rate goes up? Let's say, then in this situation they will have to pay, let's suppose, 4%. Now what is the new net interest margin? They are receiving, let's say, 5%. They are paying 4%. Obviously their profitability has reduced from 2 to 1%. So you see, this is the general impact that we're going to be talking about in the interest rate. And that's how, this is the crux of the chapter. How do they manage the interest rate risk in these two economies? That is what the chapter is all about. Okay, another concept that we have, and that is a repricing. What do you mean by repricing? Is that at a certain maturity, let's say the deposit is of a 1 year. So today, let's say I go to the bank, I have created a fixed deposit for, let's say, at a 5% interest rate. Now, obviously, 1 year down the line, as I move across the time, let's say 2026, the interest rate is obviously 6%. Let's suppose that. So in that situation, I go to the bank and I create a new fixed deposit at the current rate, which is 6%. So the concept of repricing is that if you take any instrument, now if this is a 1 year, then that means the bank has to wait for 1 year to reprice their loans, to reprice their deposits, everything, right? But what if I say that the bank is now has, let's say, 20-year loan. So the bank is earning, let's say, 3%. So the bank is disbursed a loan for 3%. And for the next 20 years, they are just earning 3% for the next 20 years. That means they're locked in. They do not have the opportunity to, if the rates have gone up, let's say, to 6%, they can give a loan at 6%, right? But the customer is locked in for 3%. So the repricing concept, what do I mean by that is, the shorter the opportunity, the shorter the duration, the bank has a better opportunity to reprice their loans and restructure. That is what the concept of repricing is. Okay, if the duration is, let's say, for 6 months, then the banks can take either, they can make adjustments in just about 6 months, good, bad, whatever that be, but they have the opportunity to adjust the rates. That is the concept of repricing the interest rate. So just good to know information. Let's go to the chapter. I think it's going to make sense now. Okay, let's talk about, describe the mechanisms through which changes in the market interest rates affects a bank's economic value and the key methods bank use to manage the interest rate risk. So what are the impact of market interest rate movements? Changes in market rates, interest rates, it affects two things: retained earnings and ultimately equity value. As I told you, the net interest margin, where does the, so if you look at the income statement or a P&L statement, you obviously have the net interest margin here, and then all the, deduct the EBITDA and everything that you do, you are left with the net income that the bank has. Sorry, that the bank has. So obviously, if the net interest margin goes up, you make more money, your net income goes up. And where does this net income goes? It goes ultimately into the balance sheet in the equity. So your retained earnings, which is here, retained earnings goes up, your equity value goes up. You see, if the net interest margin goes up. But if the net interest margin, let's say interest rate has gone down, So obviously your profitability will increase, but if the interest rate has gone up, your net interest margin will fall down, net income falls down, retained earnings goes down, and equity value goes down. So that's a thing that it actually flows. Okay, basic accounting, I would say that. So changes in market rates affect both the retained earnings, finally the ultimate the equity value. How? Via the net interest income from the income statement and through asset liability valuations using the balance sheet. Okay, so that's how it actually affects. Key sensitivity arises from mismatches in the repricing frequency or maturity. Now, see, as I told you, mismatch, it does happen. But if you have the opportunity to reprice, you can reduce that impact. So, example, if a bank holds long term fixed rate loan, but short term deposits, obviously a rise in interest rate reduces the net interest income and asset value. So, it reduces the value of the asset, right, which is the loan, and short term it goes up. That's a mismatch. What is the duration sensitivity? As I told you about the duration as well, longer duration assets are more sensitive to interest rate. If you know the basic duration formula, you realize that the duration, which is a measure of interest rate risk, if a bond of 20 years will have higher duration as compared to a loan or a bond of, let's say, 5 year, it will not have much interest rate risk. Duration is as good as interest rate risk, just remember that. A rise in discount rates can lead to decline in present value of assets and higher borrower defaults due to rising debt servicing costs. Obviously the discount rate goes up, interest rate goes up, that only we use in the in the discount rate in the bond valuation or that loan valuation formula. So if you have, obviously present value will fall down and borrower will default. That's also one of the risk that we can have. What about the risk management methods? How can you do that? You can match your duration of the assets versus the liabilities. That's one thing. You can reposition your balance sheet, adjust the loan deposit structure from, demand deposits. Maybe you can divide that into half demand deposits, half time deposits, like a fixed deposit. You can restructure that. And probably what you can do is you can use, on top of this, you can use derivatives. And that's what advanced economies actually use. They use a lot of instruments like interest rate swap to hedge their interest rate exposure. Okay, without altering the balance sheet, the deposits and the loans and everything. You can use the derivatives to hedge against interest rate movement. So these are the three things that you can manage the interest rates. Okay, moving to the next learning objective, compare the methods banks in emerging markets and advanced economies use. Let's compare it. So, what are the methods for managing the interest rate risk? Uh, Remember the crucial difference between the EME banks here and the advanced economy banks here. What are the difference? Let's talk about the net interest income, the interest component. That's what banks do, right? They take money, they lend out money. What is a major source of income? If you look at it, 65% of total income is from the net interest income. That's their core activity, I would say that. As compared to the advanced economies banks, you would see that 55%. So there's a difference of 10% here of total income. So they're highly reliant, if I have to say, the EME banks, and they are relatively less reliant, the advanced economies. What are the loan type? Mostly short term, as I showed you. So actually I prepared this, keep knowing the difference between, so you can even just see the loan type 1 to 2 years and all these things. I think this is gonna be little visual thing that is going to be helpful. So loan type is here is mostly short term or floating rate commercial loan. Floating rate because it helps to reprice at the new rate, which reprice quickly. And the loan type here is obviously long term and obviously the greater interest rate sensitivity. Net interest margin, overall net money that they get, is generally more than 2%, indicating higher interest margins and lower sensitivity to interest rate changes. Here it is less than 2% and slightly higher risk, higher sensitivity, like that. Just know this thing. What about the liabilities? They rely on time deposits over 30%. Here, as I said, they are mostly into demand deposits. Anytime you can take the money, and wholesale funding. This is what the thing is. What about the impact of the EME banks? There's a low. So overall, if you have these things, what are going to be the impact? I would say that the impact, if I have to talk about it, they have a low duration mismatch, hence less exposure to interest rate risk. If you look at these four things, and if you look at the impact of advanced economy, they have a greater duration gap. 20-year loan versus demand deposits due to fixed rate assets and short term liabilities. So, more interest rate risk. As simple as it can be. This is something that you just need to know about it. The major core difference. And then also, there's going to be certain impact on the financial metrics as well, apart from the net interest margin. So, net interest margin increases slightly with rising interest rates due to floating rate assets. So, obviously, this is just an impact, right? Obviously, if I talk about the interest margin, the interest that I receive minus the interest that I pay as a bank, obviously, if the interest rate goes up with rising interest rate, I get more from the loans, and probably I may pay less on the deposits like that. So I can on a certain things, if I have a floating rate assets, right? Obviously, this is repriced quickly. The asset side I'm talking about on the loans. Obviously, I make money on this. The ROA, however, may decline as rising interest rate lower asset values. Like if you look at the formula of the return on the assets, that's going to be that's going to be a lower because the interest rate has fallen down. Just remember this thing, that's gonna be okay. And for the hedging purposes, I would say that banks use interest rate swap to manage asset liability duration. Just good to know information, know about this thing as well. Explain the recent change in the EME's bank's exposure. Now, we talked about EME versus the advance, but there has been some changes very recently for the EME banks. What are the recent shift in the EME banks? Okay, first of all, their asset composition is changing. What do I mean by that? They have started to increase holding of fixed income security like bonds, especially domestic government bond. Now, this contrasts with advanced economies banks where government debt holding decreased due to the central bank asset purchase. So here, obviously, central bank themselves in the advanced economy, they buy back their bonds. So obviously, their holding will decrease. But this is just one of the difference that you see in the asset composition. So if you look at the balance sheet here, they no longer have loans on the asset side. They also have more of the government securities bond on the emerging market economies bond bank's balance sheet. So as a result of this, the new inclusion of the government bonds, fixed income securities now make up over 20% of the EME bank's asset, as against less than 20% for advanced economy. So that's one difference. Average duration of these securities rose from less than 6 to greater than 7 years. So earlier they used to have less than 6 years of bonds. Now they are taking more than 7 years of bonds. That's another major difference that is happening. So what are the implications? What's going to happen if this is the situation? Longer duration assets. So if you have a loans or bond which is 7 years or 10 years, obviously you are exposed to valuation losses when interest rates rise. These losses, even though they are unrealized, become realized if assets are sold to meet funding needs. And the perfect example of assets are sold to meet funding needs was that of the SVB bank. They started to sell their bonds at a loss because people were withdrawing money. They needed money. They had the asset of a bond, they had to sell it. No matter interest rates going up, down, they were facing a loss, but they still sold it. So if you realize those losses, you'll not be able to meet that funding needs. That's one of the implications. The other implication is the potential solvency, whether the bank will remain forever or in operations or not. If realized losses are too high, they can undermine a bank's ability to meet their obligations. That is the implications, two implications, whether they'll survive and they're going to have valuation losses if interest rate rise. So how to hedge this interest rate risk? Obviously, because of the portfolio wide increase in the interest rate risk, hedge across the entire portfolio, not just for the loans, for entire portfolio, not just at specific maturities, but all the maturities that you have. Hedge that and monitor. Continuously monitoring is really important. Monitoring of the valuation of the assets is critical to assess unrealized losses and liquidity needs before potential asset disposal. Value that thing before you sell it. That's what the point is. So that's how you hedge this particular thing. This is a good to know information chapter. I'm not saying a very small, short chapter that we have, but if you understand the basics, I think you'll not face much difficulty here. Okay, only three learning objectives. Make sure that you do not skip this particular chapter. All right, guys, let's move to another reading, and that is reading number 100, which is laying a robust macro financial foundation for the future. Now, I feel that before we get into this and before we learn about what monetary and fiscal policy is, I think the better chapter to actually begin with is this one. Uh, that is reading number 102, Monetary and Fiscal Policies Safeguarding Stability and Trust. Now, this is a very important chapter because it talks about a lot of policies, quite abstract here at beginning. So you have to understand things at a very high level. Okay, you do not have to get deep dive into this particular reading. Okay, and on the basis of this, you'll realize what exactly is monetary and fiscal policy, which will be useful in chapter number 100 or reading number 100, right? Which is laying a robust macro-financial framework. So let's first try to understand what exactly is a monetary policy and a fiscal policy. Monetary policy, if you look here, it is managed by central banks. So I'll just give you a very quick example here. So let's suppose that the goal of the central bank is to reduce the inflation in the market, right? So there's a lot of price increases, and the central banks want to reduce that. So what they can do is that they will influence the economy indirectly via the interest rates and money supply. So let's take both these examples, interest rates as well as the money supply here. So if you look at the interest rates, what they'll do is they will make the interest rates go higher. So they will increase the interest rates. When the interest rates are high, what happens? All the loans, they also, it becomes costly. Borrowing cost it actually goes up. So the loans and everything becomes, it goes up. And hence, people borrowing, they do not borrow much loans. They do not take loans much. And hence, people do not have money to spend. So the consumer spending drops. Demand, that is why, of the product and services falls down. And hence, people reduce the prices. And that was the overall objective. So finally, the inflation also drops. So you see, this is how using the interest rate as a tool, indirectly, the government has, or the central bank has reduced the inflation here. Similarly, if you look at the other thing that we have, that is the open market operations, what it does is that the central bank, they buys the bond from the general public, and hence they get the money from people who purchases these bonds. So indirectly, the central bank is pulling out the money from the general public or the system, and hence they reduce this money supply. Whenever the money supply is reduced, right, money has been taken out from people, money supply reduces, the demand falls down. Just as good as consumer spending falls down, demand falls down, price falls down, inflation drops. So that's the essential tool that we have using the monetary policy. So what are the tools that is used? Open market operations, policy, interest rate, as I just explained here. And what are the impacts? Well, they it can have an impact on the bond yield. We know that the interest rate does have an impact on the bond prices. Borrowing becomes costly, asset prices may go up and down. Exchange rates also is affected by monetary policy. Now, the other thing that we have here is the fiscal policy, and this is managed by governments. Okay, and it is a direct management by government. So as an example here, so you can have a tools like taxation, public spending, subsidies, all this thing that we have it here. So I'll talk about two examples. The first is the government spending, and the second one is the taxes. So let's look at the fiscal policy. So what essentially government does, if the goal is to reduce the inflation, they will cut down on government spending, and hence the infrastructure subsidies, everything actually drops. People have less money, and of course, if you have less money, the inflation uh, drops. So this is one of the things that is done via the government spending. So they basically taking out, they are spending less, and hence money supply is less in the market. That is why you see less of the inflation. But when it comes to taxes, they increase the tax revenue or the tax base. Then what happens? Less money will be with the people, and hence there's going to be less consumer spending, less demand, less price, and effectively inflation drops. So this is the overall thing that we have when it comes to monetary versus the fiscal policy. I hope this gives you a brief idea about this particular thing that we have. Okay, now what is the interaction between monetary and fiscal policy? High fiscal spending, that means a lot of the government is spending very much higher on infrastructure, subsidies, everything. That automatically increases the demand. When demand goes up, prices goes up, and hence indirectly the inflation also goes up. So when the inflation goes up, what's going to happen? Obviously, the if you look at it, when inflation goes up, the central bank will come into play, and they say that okay, now we need to increase the interest rates to reduce that high inflation, right? So that's what essentially happens. So that's the interaction between the fiscal and the monetary policy. So high fiscal spending, inflation goes up, then obviously monetary policy kicks in, and there's going to be a rate hike. As against a tight monetary policy means a higher interest rates. Already if the interest rates is very high, it becomes costly for the government to borrow the money. Obviously, as I explained here, if you look at this particular thing, if the interest rates are higher, right, the loans costly, it becomes borrowing cost becomes higher. So that against the it's a pressure on the government in terms of their fiscal policy. That's what the point is. So this creates a policy feedback loop. It's hit here and then it's hit here as well. It's a loop that goes on, where fiscal expansion gives rise to monetary tightening, and monetary tightening, that means increase in the interest rate, pressures the fiscal budgets. This is all that you need to know. I think this is the basics. Okay, there's a concept of a region of stability. What do you mean by region of stability? If you look at this particular Venn diagram here, so here we have the monetary policy, here we have the fiscal policy, and the joint probability where both the monetary and fiscal policy is connected, this is what we call as a region of stability. That means here what's going to happen is there's going to be stable economy, right? It's a balanced zone where both policies support stable, healthy growth. There's a growth factor here both in the short term as well as the long term. So that's this joint probability here is what we refer it to as a region of stability, right? Now the region of stability is country specific, it is hard to define, and constantly it shifts. Sometimes this region of stability may become shorter, okay, and sometimes it may become larger as well. So the greater, the better. But if it is very small, then there's less margin of improvements. So you don't want a situation where the region of stability is very small. Otherwise, there's not going to be stability in the growth in the economy, right? There's going to be a lot of challenges. That's what the region of stability denotes. It is influenced by gradual changes like demographics and sudden shocks like geopolitical events. That is also, it influences that. Policies like regulation or foreign exchange intervention can alter its boundary. So whatever the central bank, when it what they do in their monetary policy, and the government what they do in terms of fiscal policy, that has an effect on the region of stability, right? But this is the broad idea, I think, that you can actually take. Okay, moving on to the next learning objective, which is describe the consequences of breaching the boundaries of the region of stability. So, what essentially happened and how the consequences have evolved over time. So, we're going to be talking about two or three phases here. Phase number one, it essentially talks about from 1960 till the mid 90s. So there's 20 years of duration that we almost have it here. And in that phase during 1960, there were some policy that overreach led to high inflation and debt. So the government and the central banks took certain fiscal policy measures as well as the monetary measures, which essentially they tried to fine tune the growth in the economy. So that was the phase all about. They wanted to have better growth and better prospect, but managing this aggressively, okay, that caused inflation during this 20-year period. And of course, there was an inflation, and hence there was a price instability at that point in time. So this was the phase wherein it led, usage of monetary and fiscal policy together, that led to inflation, and hence it led to price instability. Talking about the next phase, which starts from mid 1980 to 2020, this focus moved from inflation to financial imbalances with crisis driven by excess credit and rising debt. Now, here in this particular phase, what essentially happened was after the mid 1980s, there was globalization, right? There was essentially financial liberalization. So, a lot of countries they started to invest in each other and all these things. And hence, there was the drop in the inflation. Okay. Rates were absolutely low to boost this globalization demand and everything. But due to low rates, what happened is that a lot of people started to borrow. Imagine you go to a bank without, they're not charging you any interest rate or very less rates. Obviously, people will borrow, right? And what happens? The debt went high. And due to this huge pile of debt, the excess credit that we are talking about, there was a financial instability that we witnessed in 2008, right? Lower interest rate time period. So this was a phase number two, 1980s to 2020. And after that, we had post COVID time period where stimulus caused a rapid recovery. So there was a lot of stimulus, given by the government, that increased the money supply, right? And whenever money supply goes up, what happens? Inflation goes up. The debt also went up because there was a stimulus, and of course, the money supply, the bonds, people started, government started issues bonds and everything, and hence the overall thing. Now, this is a twofold thing: inflation went up, debt went up. So there was entirely vulnerability in the financial system. So this is what essentially happened. If you breach the boundaries of the region of stability, it can lead to either price instability, financial instability, and even the financial vulnerability, right? The entire systemic risk. Now, there are a few factors that actually contributed to the trajectory of monetary and fiscal stimulus. So, what are those few factors? First, when sovereign debt levels are high, when the debt is already high, fiscal stimulus has less stimulative effect. Because obviously, what happens is that if the interest rate is already higher, and let's say the inflation is high, they want to reduce the inflation, what will the central bank do? They will again raise the interest rates. But if it is already higher, it's not going to have much huge impact. That is why we saw price instability, financial instability. There needs to be a good effect. Otherwise, it's like a diminishing, marginal returns, or kind of like a diminishing uh, effect that we actually see in terms of interest rate hikes. And more extreme monetary efforts are needed to have an impact. So a certain amount of interest rate will not do. There needs to be a huge interest rates that needs to go up in order to control this inflation. Second, there is a self reinforcing interaction between fiscal and monetary. As I said, you work on the fiscal policy, monetary takes a hit. You work on the monetary policy, fiscal deficit or debt actually goes up. So, somewhere or the other, that needs to be managed, a balanced approach. That's what we actually see here. So, that's the core idea that you need to just take away. Now, what are the implications of this foreign exchange rate dependency? Now, there's also a foreign exchange rate that affects the advanced economy as well as more to the emerging market economies. But what is the implication? The region of stability is smaller for EMEs as compared to the advanced economy. This is one thing that you need to remember. Okay, so if you look at the region of stability for the emerging markets due to the exchange rate, it's quite smaller. That's what the takeaway is. Boundary breaches amplify currency depreciation. So if the region of stability is like this, then that means a very small margin of improvements is there for emerging market economies, and hence there's going to be currency depreciation. People will not, or there's going to be, investors will take out the money. That's what the point is. Monetary policy in advanced economy can have a ripple effect in EME. Now, if there's any monetary policy in advanced economy, so let's say the advanced economy, their monetary policy, they are hiking the interest rate. Let's suppose that this hike in the advanced economy can also have an effect on emerging market economies. One country is situated here, the other country is situated on other part of the world, but still this, because of this low or this small region of stability, it can have an impact on their currencies as well. EMEs are shifting to flexible exchange rate regimes. They are moving towards the flexible. Just remember this thing out. Okay, the next learning objective, it talks about the risk that global economies face as a result of high public debt level. So straight up, you can see that what are the risks from high public debt and policy tensions? High public debt poses serious challenge to both monetary and fiscal policy. If the debt is already high, it limits flexibility, increases financial vulnerability, that's phase three, and cause tensions between inflation control and economic growth. So there's going to be a tension between these two things. Now, this debt strains government finances, complicates the fight against inflation, and introduces substantial financial stability risk. Because obviously, if there's already debt is already high, and let's suppose that inflation is already high, the very natural choice to control the inflation is to play with the interest rates, right? To increase the interest rates. But if you do increase the interest rate, this cost of debt for new borrowings also increases for the government. So this is kind of a situation that needs to be balanced out. Okay, so that's the risk from high public debt. But apart from that, there are four things that happens here. Uh, Intersection of multiple fiscal and economic factors. Okay, now including the potential for these high debt levels in combination with other factors to drive tension between the fiscal and monetary policy. So let's look at the other factors that drive the tension between fiscal and monetary policy. The very first thing is obviously the intersection of multiple fiscal and economic factors. Okay, fiscal and other economic factors. So let's say government debt, spending, inflation, interest rates, they are all closely linked to each other. Inflation has temporarily boosted tax revenue. So obviously, if inflation is high, that means prices are higher. You're paying higher prices. Obviously, the revenue or the taxes, or let's say prices are higher, we can say that wages might also be higher. So you're earning high, there comes the tax. You're paying for the prices, there comes the tax. So the revenue of the government actually goes up. So the government feels that okay, their fiscal budget is, it's going well. So their fiscal positions look healthier than they actually are. But in reality, it is not what it is actually seen. Why? Because if there's a high inflation, there's going to be some consequences. If inflation stays high, central banks must keep interest rate elevated. They have to keep the interest rate elevated, which raises borrowing cost. Okay, so obviously then the debt, or the borrowing cost for the government or the general public, that takes a hit, right? Now, this is the just the interaction that you need to actually know for this particular learning objective, or this particular intersection of multiple fiscal and economic factors. This is something that just give it a good read. Okay, what are the consequences of high inflation? If inflation is high, central bank must keep interest rate elevated, which raises borrowing cost. Now, there are two things that can actually happen. Central bank bond buying post GFC shortened the debt maturity. Now, if you look at the entire article by BIS on this, there's an entire paragraphs or an entire page of reading that just talks about how the debt maturity was shortened. But for this particular reading, I would say that just remember this thing out. Do not need to uh, get too much into detail. So what essentially, I'll just give you a brief idea. What happened was that the central bank, they started to buy the bonds after the 2008 crisis. They started to buy those bonds post GFC. Now that essentially, this movement actually led to debt maturity started to fall down. So they shortened the debt maturity. But this cut the short term cost of the bank, but lowered the remittance to them. But they did not get those remittance. Just remember this thing out. High fiscal debt increases annual debt servicing cost as well. And of course, if there's already a high debt, that also means that you have to pay higher interest, right? Which is expected to reach 6% of the GDP. That's the consequences of high inflation. Just remember this thing out. I think it's going to be good to go. Just this is all that you just need to know. But even if there is a high fiscal spending or debt, why can't you just cut it down? Why can't you reduce it? Why? Because of inflation. Inflation is high. We need to keep, the government needs to keep supporting the people, right? The aging population, they need the social welfare and all the other things. There are some global challenges which push the government spending on the higher side, and hence it is not possible for the government to actually cut down on their spending as well. This is the reason why cutting fiscal spending is difficult. Okay, now there are certain counter cyclical effects as well. What do I mean by counter cyclical? As I said, if you work on the fiscal policy, your monetary policy takes a hit. If you work on the monetary policy, it doesn't, provide much, or rather, we can say that it doesn't, it hits the fiscal policy policies as well. So, as an example, the fiscal policy, if let's say there's a deficit, that means the government spending is $100 and they're earning in terms of taxes, let's say $70. So 30, that means the 30 is something that is the deficit that government needs to borrow. So if they borrow, obviously their debt increases, debt goes up, money supply goes up, money supply goes up, inflation goes up. And when what happens when the inflation goes up? Central bank kicks in with the monetary policy tightening or raising the interest rates, right? So this is the counter cyclical behavior between fiscal and monetary policy. Now, monetary and fiscal policies can work against each other. Large fiscal deficits stimulate demand, but raise inflation, which leads to higher interest rates in return. These higher rates can turn economic weak, undermining the fiscal efforts which was initially taken. So this tension is especially visible in emerging market economies, where even weak exchange rates can worsen the inflation impact. So this is what the counter cyclical effects are. Now, high debt levels can also prevent monetary policy officials from taking their desired actions. The central bank will not be able to take their desired actions. So we term this as a fiscal dominance. So there's a lot of fiscal stimulus or dominance exist when monetary policy is constrained due to fiscally imposed constraints. The government does not want, let's say, the interest rate to go up. So in that situation, we call this as a fiscal dominance, and you cannot just play with the monetary policy or the interest rate tightening. That is just one other thing. And this situation can arise due to the following reason. Because understand, even the governments have pressure, political spending pressure. There's often pressure to maintain or increase spending in support of fiscal priorities, to give subsidies, to have better infrastructure. So that's why the governments has to do it. There's no reason why fiscal dominance exists, because of the pressure for the government to perform. That's one thing. Sovereign debt implications, and the debt which is given by the government, they have to keep paying the interest on that. Interest rate increases could spark a sovereign debt crisis under circumstances. Imagine a government has given a bond, and if interest rates keep on rising, obviously their prices are falling down, right? So even the sovereign government bonds, it has an effect. If interest rate goes up, their bond prices will fall down in value. So it can lead to a sovereign debt implications. That is why there's a fiscal dominance, and it doesn't allow much flexibility for monetary policy actions. That's the thing. Okay, moving on to the next thing, and that is the financial stability risk. Now, the entire financial stability. So understand, sovereign debt is vital for financial stability. We know that, right? You can use the sovereign debt or a bond as a store of value, like a treasury bills. It can work as a collateral and even as a benchmark, as a risk-free rate for pricing the other assets. Sovereign credit crisis, like a downgrade or default on a particular government bonds, can disrupt the pricing of risk across the economy. So we need to have that financial stability together, right? We need to have that. And government acts as a backstops. What do you mean by backstop? As a last resort. We have seen in the case of SVB Bank, we have seen in the case of the Credit Suisse, the government steps in, right? So they are acting as a backstop, as a last resort, with central banks serving as lenders of the last resort. So this creates a feedback loop. Again, it takes a feedback loop. Banks rely on these bonds, sovereigns, and sovereigns rely on bank stability. So it matters, because if sovereign bonds fall down, they'll not be able to help out the banks. So that's why that's very much needed. High debt raises the risk of sharp bond yield movements, especially during monetary tightening. In panic phases, investors may flee sovereign debt for cash, causing liquidity stress. So that's why it's important that we need to maintain that sovereign debt. Loose fiscal and monetary policy increases fragility. It makes, if market sense a breach in the region of stability, if they feel that the region of stability will just shrink, bond repricing can trigger systemic risk, and hence it's important to maintain that region of stability. Then finally, we have the policy implications. Monetary policy should focus on price stability, while fiscal policy must remain conservative to preserve flexibility. So this is what the entire policies should actually look like. Okay, monetary policy, price stability; fiscal policy, to preserve crisis and avoid fueling inflation. That's the ideal motto. Central banks should reduce the balance sheet gradually to retain future policy space. So that's how they should go. Uh, and not like abruptly they should change their balance sheet or the interest rates. Fiscal spending should prioritize long-term growth like infrastructure, not short-term transfers. Central bank independence is crucial to avoid any political interference. So the central bank should have that flexibility to change the interest rates as and when that actually is needed. Okay, so this is what the entire chapter is all about. Give it a good read and you'd be good to go. Right, let's move to reading number 100 now, laying a robust macro financial foundation for the future. Now, whatever that we have seen in the monetary policy and the fiscal policy, I think you'll be able to relate in this particular chapter very effectively. Okay, but not a very huge chapter, something that you need to remember and you would be good to go. Okay, let's start with the first learning objective. Explain why the sudden increase in inflation that reached a peak in 2022 following the COVID did not still result in a full scale global recession. Why it did not happen, even the inflation was at a peak in 2022? Well, there are four major reasons. There was a strong labor market. The employment rates was high. That supported the economic stability. People had income, people had money to spend, and that is why there was not, even though the inflation was high, there was not a recession. People before the pandemic, they had savings that helped, that money, that savings that helped them to cope up with this high inflation. There was a fixed rate loan, so people essentially, even though inflation reached high and so on and so forth, people essentially had fixed rate loans, and that is why they did not have the negative impact of the higher interest rates, right? So that was actually, the negative effects were deferred. And resilient consumer spending. Demand for services remained high, and we know that the demand is high, then obviously the prices also goes up high. But again, people had that consumer spending. Hence, income remained high as well. So that is why people still started to buy those things. Now, despite the sharp inflation surge in 2022, global recession was avoided due to resilient labor markets, delayed effects of monetary tightening, which is monetary tightening means interest rates going up, but people had fixed rate loans, and pandemic era savings and government support. That was the reason. Even the growth, if you look at this growth factor, the global growth stayed strong at 3.5% in 2022, 3.2% in 2023, and 3% in 2024. So the growth did not fell very steeply. That was also one of the things. High demand for labor intensive services during the pandemic helped maintain, have people jobs, and if people had income, they obviously will spend. So this was the very first reason, that the avoidance of a global recession. Now, in this learning objective, it talks about the disinflation. Identify and describe key factors that played a role in the process of disinflation around the world over the past year. What do you mean by disinflation? So we know that inflation is prices going up. But what if the opposite happens? The prices keeps falling down. That's inflation, or rather, we can call it temporary slowing of the rate of inflation. Okay, so disinflation is nothing but if inflation is going up, but at a very slow pace, that is known as disinflation. So, why it happened like disinflation? Here, they actually worked majorly on the supply and demand. We know that if demand goes up, the prices goes up, and hence the inflation goes up. But the other thing can also happen is that if the supply goes up, there's a lot of inventory or supply, obviously the prices falls down, and hence inflation will fall down, right? And if there is less demand, prices will fall down, inflation will fall down. So this was the two things that it actually worked here. So let's read it out. There was increased in the supply. So obviously, if the supply increases, countries like UK, US, South Africa, Indonesia, and South Korea saw greater supply, easing pricing pressures. So that hence there was a disinflation. There was end of supply chain issues. So there was, during the COVID, there was some supply logistics was stopped. Everything, there was a lot of lockdowns and everything. So end of supply chain issues. The resolution of supply chain disruption starting late significantly contributed to easing the inflation. So as I said, supply goes up, the prices falls down, and inflation takes a hit. Then there was falling commodity prices, so lower prices for key goods like energy, that reduce both headline and core inflation. Obviously, the prices falls down, inflation automatically drops. Weaker demand, as I said, there was a less demand, hence less prices, less this. Nations such as Canada, France, and Mexico experienced lower demand, which also helped slow inflation. And then we had anchored inflation expectations. So stable expectation for future helped lower control wage. Now, this is a point that people thought that, okay, inflation is just temporary, and hence people did not demand for higher wages or salary, and hence due to less consumer spending, the prices was less, and hence the demand was less, and hence inflation actually did not increase. And there was some sector specific disinflation that we saw, like transportation and food saw notable disinflation due to decreased consumer demand. If the demand goes up, sorry, down, the inflation drops. So this is just a good to know information that you need to read. Worked on in increasing the supply and decreasing the demand or the prices, and that's how you control the inflation. And hence we saw disinflation. Okay, the next learning objective, it talks about describe policy measures introduced and implemented by different central banks aimed at driving the economies toward meeting inflation targets. Now, monetary policy actions to meet inflation targets. So this is just a good to know information. You don't have to remember each uh, word by word, but just know what exactly happened to, or what was the policy measures that was actually introduced and implemented by different central banks. So Latin America, American EMEs mostly lowered the interest rates. Switzerland, Sweden, Canada, and ECB led rate cuts among the advanced economies. US Fed held initially, then began cutting the interest rates. China also cut the rates. Japan and Indonesia raised them, the interest rates. And some Asian emerging market economies use forex reserve to stabilize their currencies. So this is just, for your information, just read it out and you'll be good to go. Okay, discuss how monetary policy changes enacted by central banks to reduce inflation impacted equity price. Now, impact of policy changes to reduce the inflation. So, monetary policy, especially the rates and everything. So, equity prices rose globally except China, especially in the tech sector. Again, as I said, just read, go through it. Credit spread narrowed, reflecting reduced investor risk concern. Obviously, the credit spread narrows. That means the riskiness of the instrument falls down. Bond volatility remained high due to interest rate uncertainty. So there was a volatility in the bonds because the interest rates, will it go up, down? That was uncertain at that point in time. Bank lending standards tightened. Credit demand dropped in most advanced and emerging market economies. Okay, so this is just a good to know information. Okay, the last learning objective talks about what is describe the monetary, fiscal, prudential, and structural policies that needs to be adopted to promote long-term sustainable growth and low inflation. So, as I said, hopefully that what do you mean by monetary and fiscal policy? I think that would be clear. In monetary policy, interest rates should be lowered cautiously and gradually. When you either reduce the interest rates to boost demand, to boost growth and everything, to promote long term growth, make sure that you do not reduce it at a very fast pace, right? It should be lowered gradually. And the central bank should avoid stop go policy changes. That means stop and then just suddenly takes a drop. That create instability or encourage excessive risk taking. Maintain a rate buffer to allow flexibility for future inflation control. Imagine if the interest rates currently is, let's say, 1%. What is the maximum that you can reduce it to? Maybe 0%, right? Or there the point, there's no point in having a negative interest rates, right? But the point is that if interest rate is already, let's say, 0.02%, it's almost as close to zero. You do not have any room for more improvements, more interest rates going down. So there should be a rate buffer to allow flexibility for future inflation control or economic support, whatever the scenario is. For emerging market economies, use foreign exchange reserves prudently to manage capital flows and prevent sharp currency depreciation. Okay, so foreign exchange reserves should be used prudently for EMEs, and this is especially important when interest rate differentials with advanced economies widen. So there's a lot of, I hope that you remember the interest rate parity. If there's a huge difference between the interest rate differential, that can have an impact on the appreciation or the depreciation of a particular currency, right? So that should also be used for EME banks. Okay, fiscal policy. The focus of the government should be to reduce the debt or the deficits so that to have uh, ease on the inflation and the interest rate pressure, right? That should be the ideal focus when it comes to fiscal policy to promote long term growth. And they should prioritize spending on healthcare, pensions, the aging population, basically the green transition, climate response, and defense, which is during this global tensions. So that should be the priority of the governments on the fiscal policy aspect. Eliminate outdated pandemic related transfers and avoid unnecessary new stimulus package. That should not be the case. Improve their tax revenues. So for advanced economy, they should broaden their corporate tax base, and for EMEs, they should simplify the tax systems and improve enforcement so that people start paying the taxes, right? So that's what the suggestion here is. Use private control for long-term infrastructure and development projects where feasible. So they can use private capital as well. So that's the fiscal policy aspect that we have. Now, what do you mean by a prudential policy? Prudential policies aim to ensure the financial stability of the system. That's the focus when it comes to prudential policy. Macro prudential policies should not be relaxed too quickly as they were initially tightened for long term stability. So, whatever macro prudential policies that the government take, they should not be relaxed too quickly. Regulatory authorities must be prepared to take sudden actions to avoid any stressed situation. See, in the short term, any action that regulators need to take, they can take that. For a long term, a complete and proper implementation of the Basel III provisions is required. That is what is being suggested in the long term when it comes to prudential policy to maintain that financial stability, right? Because if the financial is stable, then only it would make sense. A stronger regulatory framework is needed for non-banking financial institutions, especially like private credit, which we just saw in the chapter, right? Where leverage and liquidity mismatches are harder to detect. Okay, good to know information. Just read it out. You'll be good to go. And when it comes to structural policy, structural reform should focus on expanding long term economic growth. So, what are the key areas of reform? Like there should be more competition, better competition, flexible labor, product markets, R&D investment should be high. That's the areas of reform. When it comes to structural, what do you mean by structural? Like long term economic growth. That's what they should maintain, that structure. That is what we are talking about. It requires global coordination and targeted government support. Just read it out, and I think it's going to be good to go. Okay. Interesting chapter. Something that it takes the monetary and fiscal policy from 102 reading, the next chapter, which we have already done previously. All right. About the private credit first. Okay, what do we mean by private credit? In a nutshell, if I have to describe this thing, private credit is kind of like an uh, it's like an intermediary that you have, or basically the definition, if I read it, it refers to non-bank corporate credit provided through direct bilateral agreements between lenders and borrowers. Okay, so it's not a bank. Remember that. That's the very core thing that you actually need to remember. So here, if you look at it, so there are end investors, let's say any investors, institutional investors, high net worth individuals, people with long term investment horizon. So these are the end investors here. What they do, and you can call it as a pension funds, the insurance corporations, sovereign wealth funds, the government basically, and the retail, the retail investors like us. So here is the end investors. What they do is that they give money to these intermediaries, which is what we call as a private credit fund. Okay, what are they? They are a non-bank corporate credit providers. That's what they are. So what they do is that they take money from these institutions, the end investors basically. They pool it here into these separate funds, like an open-ended fund. There could be a closed-ended fund. There could be business development companies. They establish that, or they can create a tranche like structure, like a CLO. They pool the money here in these funds. Not only that, they take the leverage from these banks as well. So they are getting money from banks as well. Okay, so this end investors, banks, they all pull in the money. And then what they do is they create certain structure like floating rate loans, which are stricter in the terms and conditions, the covenant. Degree of control is very high, customized terms, few lenders, everything, right? There are only few private credit funds. And then they give loans to these mid-sized small companies which are already highly leveraged. They have already taken loans somewhere else. They are not able to get a traditional bank loan. They reach out to this private credit fund for money. They pool the money from the end investors. They are the middlemen and they give the loans. Okay, that is what the concept of a private credit is. So they are the intermediary. They take money from end investors. They give out to loans to corporates who does not is eligible for a traditional bank loan. As simple as it can be. Okay, that's the private credit. Okay, so private credit refers to non-bank corporate credit provided through bilateral agreements between lenders and borrowers. It excludes public securities and traditional commercial bank lending. It does not include that. What are the key characteristics? Direct lending involves no banks, no public markets. You do not have to issue anything. Okay, loans are directly between asset managers and borrowers, so it's a direct relation. It You can customize terms and conditions. There is a higher interest rate and total cost. Obviously there's a, it's like going to an NBFC like that. So higher interest and total cost will be higher. At the same time, total if there's a higher interest rate that you're charging, obviously there's going to be credit risk will be higher, and chance of illiquidity could be there. It includes strict terms and conditions. There's a strong lender borrower relations. Obviously the corporate has a relationship between the fund and this. That's why they're giving them money. Otherwise they wouldn't give it to any person like that. So they have a strong relationship. Who are the investors in private credit? You have pension fund, insurance, sovereign wealth funds, as I told you, family offices, retail, right? And what are the structures? They create different structures, like they can pull it like a tranches. They can have a BDC, the open-ended funds, closed-ended funds. Basically, this particular diagram, if you just look at it visually, I think that's gonna give more idea about this thing. Okay. Who are the borrowers? Obviously, small, medium sized companies like healthcare, tech with already high debt, or maybe they are new, a startup you can consider. They do not have much earnings, but they want money, right? And often ineligible for traditional bank loans. So they are backed by private equity and hence strong relationship. They know people, and that's how they are the borrowers. So they are the borrowers and they take money from this private credit funds. And the loans are traditional, right? It's a floating rate. It's not a fixed rate, floating rate, collateralized and customized. So, is there any alternative that is available to these borrowers? Yes, you can go to a bank if you're eligible. Public debt, you can issue bond, equity like that, and you can take a syndicated. loans or a leverage loan. Syndicated means two, three banks come together to give money to a borrower. That's what we mean by that. These are the alternatives. Good to know information. Okay, the next learning objective talks about the return profile and growth profile of a private credit asset class. Look at the growth of private credit, like the relationship between the borrower and the lender. Let's see how that big is. It boomed after the 2008 financial crisis. Why? Because low interest rate scenario and tighter bank regulations. Bank was not giving the money right after the crisis. It reached $2.1 trillion in 2023. Can you imagine that? $2.1 trillion. Uh, it even competes with high yield bonds. Growth is strong in North America, which is also rising in Europe, Asia, and it shifted from mid-sized firm. Now, this is the trend that is happening. Uh, Private credit funds, they are actually shifting from medium-sized firms to even larger corporates, large companies. Why? Customization of the terms and conditions, few disclosures documents, lower issuance cost. You don't have to get to the investment banking to raise a bond to all the other placements that you need. So lower cost as well. And if you look at the growth, it is as it mirrors the growth of private equity. As private equity is growing, same the private credit fund is also growing. So the growth is similar. And of course, these private credit is often backed by PE firms as well, private equity firms as well. If you look at the returns, we spoke about the growth. Let's talk about the returns as people making money. Since 2020, underperformed. If you look at the the private credit funds, they have actually underperformed private equity sector, but they have beat the real estate, venture capital, and even the S&P 500 index, which is, and you can say that it's similar to natural resources. But if you look at the time duration from 2008 to 2020, as I told you, after 2008, they started to grow a lot. So obviously, it outperformed the private equity sector, even the real estate. And from 2008 to 2016, the specific these years, it lagged natural resources but matched them post 2016. The commodities, basically. So this is one differentiation. Know it, okay? Know it for the exam. Okay, moving on, describe and assess the risk and vulnerabilities related to private credit and explain how private credit can pose risk to financial stability. Now, obviously, it's a $2.1 trillion, which we just saw that. So, obviously, it can pose risk to the financial stability as well. So, what are the risks to it? So, private credit replaces regulated lending with opaque, unrated loans and making risk hard to it. Obviously, I mean, think about it. You are giving a loan to person. You don't know the terms and conditions. It is opaque. It's not transparent. It's between those borrower and the lender. The loan is also not rated, and it's hard to detect. Just 1 minute. So when I talk about the financial stability risk, it's really there are no transparent terms and conditions. The loans are not even rated, and hence it becomes harder for the regulator to actually detect any kind of a risk. Though current risk appears to be moderate, however, there are certain concerns like low transparency, as we just said, and weak underwriting. It's a relationship kind of, you can consider that. So there are probably the underwriting process could be weak and hence more risky. There is also no stress test done or a scenario done, like what if the customers they do not pay us back, and of course falling risk premiums and looser covenants, like not strict covenants, and the risk premium, you're not demanding much of the risk interest rate that you need to demand. So all these things are something that is there, which is a risk to financial stability. What could be the possible systemic risk? Include the following and how to mitigate it. Now, there are certain risk. What I've done here is that I've taken the LOS number C and D, I have combined it together so that you have a better understanding. If you read the reading in the Schweizer, you will have to first know what all the risk that are there in a private credit funds. And then in the next learning objective, it takes how do you resolve that specific risk. So what I've done here is that I've actually combined this particular thing here. I've combined those two learning objectives. So if you look at the possible systemic risk and how to mitigate it, this is learning objective C, this is learning objective D. Okay, the very first risk, just like a traditional bank, when you give money, what happens? Credit risk. So what do you mean here in private credit funding? So the private credit borrowers, they mostly take floating rate loans, making interest costs meaning interest costs rise when rates do. This increases default risk. If the interest rates keep going up, they'll not be able to pay the EMIs. And that increases default risk. So that's a very first risk. In such cases, borrowers often are given temporary relief, which is a good thing, but it can be a bad thing as well. So what happens is that, let's say the borrower has taken a loan of about $100 million. The interest is due, let's say $1 million is the interest due, but due to some reason they are not able to pay the interest. So what they do is that they rather than taking the interest, they put this interest amount into the principal that is pending. So 100 plus 1. Now the new principal would be $101 million. So your principal, the interest component is added to the principal. But for the future repayment, that increases the pressure. You don't have to pay interest now, but that increases future risk. So that could be one benefit or a loss as well. Despite these risks, private credit has historically shown lower losses than high yield or junk bonds and similar losses to leveraged loans. So why? Because obviously there is a backing of private equity to the company startups as well, and they also take some sort of a collateral. So that's why they have a lower losses. But how do you mitigate the credit risk that still exists in private credit funding? Well, what I'm going to do is I'm going to avoid over reliance on ratings or internal models. So as I said, insurance and pension funds, they are the end investors. They give money to the fund, private equity funds, and they give it to the borrower. So if insurance and the pension funds, they are using their own internal models to uh, underwrite the risk or to understand the risk of that particular borrower or the fund, basically, they should not do or heavily rely on that. That's what it should not be done, because in an ideal scenario what happens is insurance companies and pension funds, they use ratings. So they should avoid using that ratings or internal model, because we know that ratings is, it takes time to change the rating, right? It takes time. So that's why you should not be relying too much on ratings or maybe their own internal models. That's what the first thing that I'll do. Secondly, apply bank like controls, like how a traditional bank does. Use that. Maintain high underwriting standard for loan approvals, accurately monitor performance of a borrower, establish and follow robust internal risk policies. This is what I will actually do. Think like a bank, work like a bank, like that. Okay, the next risk factor that we have is the liquidity risk. Obviously, the money is you not going to be pay me back. That's credit. You do not have enough money, that's liquidity risk. So liquidity risk, private credit funds, they face liquidity risk due to illiquid assets. They have given a private loan to a borrower. So to manage this, they use tools like lockups, like for a certain time period it's going to be locked in, limited redemptions, gates, and suspension. What do you mean by this? Basically, if you look at the structure here, private credit funds, they take money from these investors and then they pass it on to the borrowers. So obviously, if the pension funds or retail investors, if they demand money from the fund, that's saying that, okay, now I need my fund. So to prevent this liquidity risk, what these funds, private credit funds, what they do is they have certain lockups, they have gates, like certain time period, they have a suspension, all the other things that can help them, you know, because obviously this is a loan given to the corporates, right? So only if they pay to them, only then they'll be able to pay back, right? So to have this, to prevent this liquidity risk from the investors, they have all these kind of features. Okay, so that is what the liquidity risk here is. Private credit funds, they give a loan to a corporate or a startup, let's say that, which is illiquid. We don't know when they're going to pay back, when they will have better earnings and everything. So that's why they put all these things: limited redemptions, lockups, gates, and suspensions. There's also another type of fund, which is semi illiquid evergreen funds, which allow ongoing capital and partial redemptions pose higher risk. So there are certain things. Let's say you and I are a retail investor. We think that, okay, let's invest as an investor in private credit funds. So we can choose a fund which is called as semi liquid evergreen fund. So semi liquid, that means it is, you can take some more money out of that particular fund. You can have partial redemption, certain amount you can take it back as an investor. So this poses higher risk, especially with more retail investors, as I said. Now another potential risk arises when borrowers draw down credit lines simultaneously. Obviously, I have given a loan, I have committed to give a loan of $100 million to a particular borrower. Let's say any startup you can think of, right? Now obviously they have only utilized, let's say, 70 million as of now. So they can ask, they can demand money. Let's say that you have approved $100 million loan, give us more 30 million, we need it after 6 months, or we need it today. So this credit drawdown, that can also create a liquidity risk. Where will the private credit funds get the money from, right? So all this thing they have to understand. That's what liquidity risk is all about. Now, obviously, how do you mitigate that liquidity risk? Favored closed end structure. Like you, as an investor, you put in money for 5 years, you'll not be able to withdraw for the next 5 years. Only after that, you get your money back. Limit redemption frequency, like 6 months, 1 year, like that. Frequency should be reduced. Require advance notice and longer settlement. Okay, you give a notice of at least 30 days, 60 days that you need your money back. So if you have advance notice, you can arrange for that money. You'll not have that liquidity risk. And longer settlement, that, okay, we'll send you the money within 15 days, 20 days, like that. Clearly disclose redemption rules and risk of illiquid assets. This is what you need to do. Okay, moving on to the next risk, and that is of the leverage. If you look at the structure here, if you just look here, and you would realize that the private credit funds, basically, they, so this is the fund here, they take money from investors, they take money from banks, they give out money to the corporates who already are have taken money from private equity, venture capital. They're already leveraged. So if you look at it, it's really hard. And let's say I am a retail investor, maybe I have taken a loan to invest in private equity, maybe I am also leveraged, maybe the pension funds could be leveraged. So the point is that it's really hard. If you look at the structure, you really cannot figure out what is the ultimate amount of leverage that goes into this kind of a structure. They are leveraged, this is also leveraged, probably they are also leveraged, they take money from banks as well. So leverage is a huge risk that we have in this kind of a structure. So when I talk about the leverage risk, while private credit funds may look conservatively leveraged, you may see that, okay, the private credit funds, they do not have leverage. System, the overall structure has multiple hidden layers of leverage. Investors like pension funds, they use leverage. Funds, they use SPV like the CLO that I spoke about, and other structures. Borrowers often borrow from credit funds and PE sponsors. They are also leveraged. Think about a startup kind of a situation. So this kind of a less transparent or an opaque interconnected leverage. If borrowers do not pay the money, private credit funds will fail. If they fail, the investors' money will be lost. So it's interconnected, makes risk investment assessment difficult and increases systemic vulnerability. So there could be stress events that may trigger collateral calls to the borrower and capital shortages if there are any stress events, especially if many borrowers draw credit lines at once. If there's a stress event, competition, whatever the situation is, if a lot of borrowers they demand more credit, that could that could be risky. Okay, so that's what we mean by leverage risk here. So, how do you mitigate the leverage risk? Well, obviously, improve transparency as much as possible. Do not have opaque system, have transparent systems. Bank oversight. Think like a bank, work like a bank. Banks lending to private credit firms should demand, if bank is lending to private credit firms, they should demand liquidity stress testing of their portfolio. Do a stress test of the loans. Asset write down readiness. Are you able to write down that particular loan which the borrower is not paying? The readiness should be checked. And draw down stress scenarios, like stress scenarios of the drawdown, like how likely a borrower, if we have committed $100 million as a loan, the borrower has only drawn so far $60 million. How likely that the borrower will draw down the remaining $40 million? So you need to have that kind of a stress scenario as well. That's two ways that you can actually do it. And as I said, there's a lot of opaqueness, less transparency. So to overcome the data deficiency with leverage reporting, obviously what you can improve? Better reporting across borders. Regulatory coordination. Regulators should coordinate to spot hidden leverage. Leverage caps if risk levels become systemically dangerous. So there should be a leverage cap. If it goes above that, that's going to be a dangerous situation. That's what we can do. Okay, then we have few more, and I think we'll wind up. The other one is the valuation risk. Now, what do you mean by a valuation risk? Obviously, how will you value a private credit fund? Like, what is their overall value or the valuations? How do you do that? Private credit valuations are often unreliable. Why? Because there is no comparable trade. You cannot compare it to one competitor to the another one. Uh, Infrequent updates, there's not much data or information, and there is no active secondary market. You cannot compare it, or you cannot say that, okay, this particular fund is working like a particular bank. You just no active secondary market for it. That is why it's really hard to value a particular private credit fund. And moreover, on top of that, the loans that they give, they are also illiquid. They have their own terms and conditions. So you cannot even price that particular loan or that particular assets. It becomes really difficult. And if you go to a specific third party vendor external estimates, that may be biased, and no standard rules exist. That is why there's a challenge of a valuation risk. There could be a concept of a stale valuation. Maybe past good data points are captured, not today's reality. So stale valuation that can overstate good returns, mislead investors, and inflate the manager's performance fees. That could be one of the things. And that could also delay recognition of losses. As I said, if you have stale past returns, not current return, then obviously maybe if you're facing loss here, that's not reported. There could be a delay of recognition of losses. That's the valuation risk. How do you mitigate something like this? Well, there's no regulatory oversight here. There's no regulation. Hence, investors rely on their own valuation methods, which causes inconsistency. Maybe pension funds, they have their own method. Insurance companies, they may have their own methods. So what is the solution here? Regulators should monitor the valuation practices. They're asking regulators should do that. Require audits, external audits for illiquid assets. Ensure timely and accurate write downs. If the customer is not paying or the borrower is not paying, accurate and timely write down so that they know what has been the losses. That's what the solution here is. Okay, then the last two is the interconnected risk. Obviously, if you look at the interconnected, I would say that lot of, if you look at the structure, you see that everything is interconnected, right? So private credit is tightly linked to private equity firms, banks, institutional investors, and many funds are run by the private equity themselves. So managers, borrowers, they are often PE backed, private equity backed. So this raises systemic risk, because if this funds goes bad, if their loans go bad, everything, that's what the point is. And again, there's going to be a conflict of interest as well. If the manager, borrower, everything is run by PE, they take money from banks or pension funds and everything, institutional investors. So there could be a conflict of interest concern as well. In a stressed scenario, a large capital call or default at one fund can trigger a chain reaction affecting other participants and reducing funding availability across the financial system. That could be one of the risks. How do you mitigate such interconnectedness? Limited data on these risks calls for greater cross-border, cross-regulatory. Say they're asking for regulatory. If you look here, the previous one valuations as well, regulatory cooperation is what they are essentially asking. Especially when exposures are concentrated, regulators must work together to identify risk build-ups and share critical information for effective oversight. Regulators, they have to be active on this. Okay, then we have the underwriting risk. So obviously, as a manager of a private credit fund, let's suppose that your incentive is based on giving maximum loans. What would you do? Obviously, you say that, okay, probably you may loosen the covenants which was supposed to be strict, but there could be less underwriting. If less underwriting, there's going to be a credit risk or an underwriting risk. So the fast expansion of private credit has increased competition for large corporate borrowers. So competition, right? But at the cost of underwriting discipline, that has gone down. This has led to weaker credit standards, less thorough due diligence, and potentially higher default risk. Just right. So that's the underwriting risk. And finally, there's going to be a conduct risk as well. So understand, what do you mean by conduct risk? Let's say I am a retail investor. I may not have much authority in that particular private credit fund. So the supervisor, the manager in that particular private credit fund, they may have misused my funds and everything, right? So that is a conduct risk. So supervisors must identify conflicts of interest, ensure clear disclosures, and prioritize investor interest, my interest. That's what they should do, especially for retail clients. That's what conduct risk is and how it should be mitigated. Controls should ensure retail investors understand the risk involved. I should understand what are the risks that may be involved in the private credit funds. So this is what we have in this particular chapter. All right, let's move to reading 103, which is the regulating the crypto ecosystem, the case of unbacked crypto assets. Now, let's look at the first learning objective. Define and describe the crypto assets, including the categories broadly used by global financial regulators to classify them. So let's look at certain definitions or basics here. What is an unbacked crypto asset? So it's a decentralized or sometimes centrally issued. They are mainly used for speculation, which is not backed by any specific asset. For example, if I say that a commodity contract is maybe backed by certain commodity, but here when it comes to a crypto asset specifically unbacked, it is not backed by any financial asset. So you can have, like, example is a Bitcoin or an Ether. Now this are mainly used for speculation purposes. What are utility tokens? It is like a gaming token. You buy a specific token to play a game, or to enter into that gaming zone, right? That's a utility token. It allows access to a specific product or service within a single or closed network. Security tokens, it is as good as a digital security that you buy, just like how you buy a bond or an equity share. It represents rights similar to traditional securities like profit sharing or ownership, and definition can vary by jurisdiction. Stable coins, it is aimed to maintain price stability by being pegged to assets like fiat gold or other crypto. So example, Tether, USDC. So here this is a coin, a stable coin, which is backed, or it has the effect of USD currency going up and down. As USD goes up, their value also goes up. As USD prices goes down, their overall value will also fall. So that's the stable coin. It is pegged to a certain currency or a gold or any kind of an asset. Okay, what are crypto assets? Crypto assets are digital assets that use cryptography and distributed ledger technology like blockchain to securely record transactions. So let me just explain you in just a brief as to what blockchain is. So what happens is that if you have, let's say, Bitcoin, and you want to transfer from here to, let's say, another network or another to another people, let's say that, in that situation, what happens is that this is the front end, like you just take your phone and you just transfer it. But what happens in the back end is there are like validators or miners who will actually miners they will actually validate the information, and they mine this particular thing, and that allows in the back end to transfer from this to this, let's suppose that. And then here, let's say from this it moves to another person or another location. So the same details what I mentioned here, it's going to be transferred here, and then new information can be added here as well, like the amount, quantity, so on and so forth. So this kind of a technology, and again, the validators, miners, they do the back end task and the processing. So essentially, what happens is that this is known as a distributed ledger technology, DLT, distributed ledger technology, wherein, let's say, you're transferring from one person to the second person to the third person. So all this information gets stored in each of the chain, right? So it passes on from here, it passes on from here, like that. So this is just a very simplified example, but I hope that you get the context here. So crypto assets, consider Bitcoin. They are digital assets that use cryptography, the validators and miners use that, and DLT technology like blockchain to securely record transactions. So why did you pay the Bitcoin, for which purposes? Let's say that. So blockchain, which is the most common distributed ledger technology, stores immutable transaction records in linked blocks. So it stores, everything is stored in these blocks, whatever that you mentioned. Now, crypto assets can be backed or unbacked. So, stablecoin is example of a backed asset. Unbacked is a Bitcoin. Unbacked assets like Bitcoin have no intrinsic value, rely on supply and demand, and are highly volatile. If the supply demand, it's a function of that. Mainly used for speculation rather than as a true money. Okay, now I've got this here. Just read it out. I think it's going to be good to go. So there's like an NFT tokens. It is usually centrally issued right to ownership of specific product, collective and non-substitutable. Just know that it's centrally issued, and there's a right of ownership when it comes to NFT tokens. Okay, it's like a tokens. Uh, Security token. It is centrally issued, again, meets the definition of security in each respective jurisdiction and within the regulatory perimeter. Utility tokens, for any utility, centrally issued right to product service except across multiple ecosystems. Just good to know. Unbacked, like the Bitcoins, usually decentralized. This is only difference here. This is centralized, centralized, centralized. This is decentralized, designed to be used as a means of exchange. Limited rights for the token holder, no single issuer to enforce rights, transferable as well. And when it comes to stable coins, it is designed to be value stable. It is pegged to certain assets, like that. Just remember that. CBDC is a central bank digital currency. It is central bank, as the name suggests, so it's obviously centrally issued by a state or a central bank, designed to be value stable. Stability mechanism is usually sovereign fiat currency. Just read it out, okay? You don't have to remember it, just read it out. You'd be good to go with this. Okay, describe the key components within the crypto ecosystem. Now, obviously, there are many components, but we're gonna be deciding those components as per the people who are associated, the networks and everything, right? So, first off, obviously, the issuer, the people who are issuing, let's say, the Bitcoin in our scenario. So, the people who are issuing, they are known as issuers. Usually they are decentralized and they offer unbacked crypto, offer access and anonymity, but are hard to regulate. I don't know who is the issuer, who has given that. It's purely anonymous, so there's really hard to trace that or to regulate that. Hence disclosures are limited. Network face risk like cyber attacks. This is a major risk when it comes to the crypto ecosystem, okay, in terms of issuers. Now, the issuers can issue, let's say, any coin or a Bitcoin via pre mining, ICO, just like IPO, like initial public offering. Here it is called as initial coin offering. Okay. But it can also lead to fraud and manipulation because there's limited access, anonymity is very less, really hard, high chances for cyber attacks and so on and so forth, right? There's a concept of a white paper that often exaggerate benefit. What is a white paper? White paper is like a policy document. Just when you purchase any policy, similarly, the issuers, they issue the white papers. Marketing materials, including white papers, often exaggerate benefits and hide the risk. Okay. So what are the regulatory response? See, what does the learning objective talks about? What are the key components within this? The potential risk that they can have, and the potential regulatory responses to address those risks. That is what the learning objective is. So, what are the regulatory response? What does the regulator wants? Well, when you publish a white paper, that marketing brochure, okay, emphasize clear, accurate, and understandable language with essential details about the asset and its risk. That's very, very important. Notification process, suggesting a mechanism for regulators to be informed about white paper availability to monitor developments and risks. So continue notify the consumers. Suitability, is it suitable for me? Is it suitable for you? Recommending assessments to determine if crypto assets are appropriate for retail investors. Let that be published in the white paper. Marketing, advocating for fair, accurate, and transparent marketing materials aligned with the white paper. So you can market as like, okay, it's good, it's going to give you solid returns, but that needs to be fair, accurate, like that. Consumer should be educated about the risk of investing in crypto assets. That's what the regulatory response is. Stressing the importance of financial and technology literacy programs about cryptocurrencies, so on and so forth. That's the regulatory response that we have. Now, what are the crypto asset exchanges? So that's first we spoke about the issuer, the risk that they can have when it comes to white paper, marketing, so on and so forth, and the regulatory response. Now let's look at the exchanges where cryptos are listed or you can buy it from. Exchanges facilitate buying and selling of crypto assets and may also act as custodians where you can keep your coins, or they can act as a market makers. As a if you want to buy that, they can become a seller. If you want to sell it, they can become a buyer by trading from their own inventory. So that's what they essentially do. So crypto asset exchange, they provide direct retail access. If I want to buy it, I can go to that particular exchange. It enables individual trader to engage directly without intermediaries. Like for example, in if you want to buy into, let's say, derivatives, you may have to go to a CCP, or a member of a CCP. They go to the CCP and then that goes to the exchange. Here it's a direct retail access. So there are no members, no CCP, nothing like that, right? You just go to it, you get it. They trade from their own inventory. As I said, they become the market makers themselves. So they trade from their own inventory. They provide custody service as well. They offer storage of your coins, the asset, crypto assets. You can store it with them. That's what they do. But what are the risks of crypto asset exchange? Well, first of all, there's a custody risk. If you store your, let's say, Bitcoin with a particular exchange, that particular wallet could be hacked. So there's a cyber credit or a counterparty risk. Operational and cyber threat, it could be hacked. There can be bankruptcy to the exchanges themselves and even the loss of the asset, right? There could be market manipulation, like, of course, we don't know their exchange style and all these things. So it is high in anonymous, and the market is also very illiquid. There is a proof of stake. POS stands for proof of stake. So as I said, the validators, the miners, they mine it. They get that particular transaction done by using proof of stake. But don't get into that. But just remember this: large exchange can dominate proof of stake network. What do you mean by proof of stake? If I just have to let you know in just a very short way, I would say that is that, let's say if you have a large computer or a large system process, you'll be able to mine the coin effectively. Imagine the exchange, the amount of money that they have, the bandwidth that they have, that they can have a best of the best systems to mine the coins, right? So large exchanges can dominate this proof of stake networks, increasing centralization and potential conflicts of interest. So they'll do things which would be in their favor. That is what we have it here. Okay, changes in regulation for crypto asset exchanges. Crypto regulations differ across countries, with many lacking clear rules. Most focus on lower risk tokens, allowing exchange to avoid oversight by listing unbacked crypto assets. Regulatory gaps remain, especially for decentralized platforms. Which are decentralized regulations? It's really hard to detect them, right? Okay, that's what we have for that. Now, the within this particular thing, we have another category, which is the wallets. Okay, so wallet is the third thing. That where do you store that? In a digital wallet. So digital wallet, it stores the private keys needed to access the crypto assets which are owned by users. Losing a wallet means losing the private key, and therefore your Bitcoin or the asset or anything. You can just think about that. That's the digital wallet. Now, there are two types of wallets. First one is a self custody. That means you keep it with yourself. So you have control over the private key. You bear full responsibility for security, but risking it, but risking irreversible loss if the keys are lost. So I keep the key with me for that digital wallet, the private key, and if I lose it, I lose the asset. And then you can go to a custodial service like an exchange or something. Third party exchanges manage the private keys. This reduces my burden, but introduces risk like cyber attacks or mismanagement. Again, this is the type of wallets that we have. Classification of wallets. Now, there could be two types. Hot wallet is online for quick transactions, which is vulnerable to cyber attack. I can pay it via digital way. A cold wallet is offline for secure long term storage, susceptible to physical risk like damage to USB pen drive, but preferred by exchanges. So you can keep your private key in a pen drive. That's a cold wallet. And when you attach your pen drive, only then that private key is visible to you. So that's a cold wallet. Now, wallet security in crypto regulation. So, what are the regulatory priorities? Regulations aim to protect user assets through segregation, strong cybersecurity, accurate digital ledger technology based records, anti money compliance, anti money laundering compliance, prudential norms, cyber insurance, wind down plans. Just give it a good read. No need to get too much detailed into this particular thing. What the regulatory priorities? Just read it out. Okay, as I said, there are validators, miners, and the technology that they use. Validators, they validate it at the backend task. So, digital ledger technology improves security in the financial services through immutable transaction and audit trails. Private blockchains offer more control but suffer from fragmentation. Now, what do you mean by this? Is that you can have blockchains which can be divided into multiple things and it becomes really fragmented, right? There's a limited interoperability and centralization risk as well. Initially, when Bitcoin or all this crypto assets were launched, their theme was to have a decentralized approach. But if I have the best of the best computer systems, the best of the best validators, I'm the best of the best miner, obviously the power lies with me. So in effect, I'm controlling that. So that centralization risk, there is still there in a private blockchain. But as against to a public blockchain, they are resilient to single point failure. So if let's say a particular coin is hosted by a particular exchange or anything like that, if that public blockchain is cyber attacked or anything like that, then that's a single point failure, but faces risk from user behavior and governance issues. So there can be user behavior and governance issues. Just give it a good read for this thing. Don't get stuck in this a particular case for the validators, miners, and technology. Okay, moving on to the regulated financial institutions. Banks and financial firms face risk from direct exposure to volatile crypto assets and indirect links. So now, obviously, banks, let's suppose that the bank has lent me some money. Now, I take that money and I invest in crypto assets. So, banks' indirect exposure to the crypto assets is what we are talking about in the regulated financial institutions. So banks and financial firms, they face risk from direct exposure. Maybe they have bought it directly, or maybe indirect exposure, like lending, insurance. They have insured that particular crypto assets like that. So Basel, it proposes risk-based classification. The unbacked crypto would attract higher capital requirements. So if there's a bank in their balance sheet, if they have the unbacked crypto, remember the risk weighted assets that you calculate, it is going to be higher for the unbacked crypto assets. So what is the current regulatory focus? Current regulatory focus is on a conservative approach. Capital will be deducted uh, for using this unbacked crypto. Stricter risk weights and monitoring exposures. Okay, how do you need to monitor your exposure to this unbacked crypto? Institutions like asset managers, brokers, and insurers are increasingly offering crypto related products that increases systemic risk. Even the asset managers, brokers, insurance companies are increasing offering crypto related products. So you see, we need to regulate the financial institutions, not just banks, financial firms, as well as these asset managers, brokers, and insurers as well. Now, crypto asset provider functions and market infrastructure. In crypto markets, single entities handle multiple functions like custody, clearing. Think of an exchange. That raises risk. This concentration can lead to disruptions, unlike the segmented traditional markets. Regulators must identify systemic crypto players, large issuers, and treat them as financial. So FMI is the new word, financial market infrastructures. That is what we mean this by here. Okay, moving on to the next learning objective, which is the identify and describe some of the global approaches to the regulation of unbacked crypto assets, including the BCBS proposed treatment. Now, this is just the important thing here is this particular paragraph that we have it here. So remember this thing out, and the rest is just the details that you just need to go through it. Okay, what are the global approaches to regulation of the crypto markets? Regulating crypto assets on a national setting may be sufficient in the absence of harmonized global regulation. Domestic regulation can be too much or too broad or too less. Examples of different regulatory focus includes stable coins and tokens, operational aspects in the Japan and Albania, jurisdictions can be crypto friendly or restrictive in the case of Nigeria, right? Activities relating to crypto assets can bypass the domestic rules and regulation, especially where monitoring is difficult. As a result, stronger international cooperation amongst regulatory is needed to address systemic concerns. But this is just important here, as I said. Instead of broad banning on crypto assets, regulation should mainly focus on clarifying rules relating to the economic functions of crypto assets and technical design. So, what are the rules or things that we should do? The BCBS, it proposes to categorize banks' asset holdings as either low risk or high risk assets into two categories. Low risk would have a similar or a lower risk weighted assets, like a risk weight that we have in operational risk, than traditional assets. Obviously, they'll have lower risk weighted. While higher risk assets, let's say crypto in this case, would have significantly higher risk weights, which is 1,250% risk weight for both short and long term. So if any bank has crypto exposure, let's assume that, and in that situation, 1,250% risk weight capital should be reserved. That's what the proposal here is. This is just that is crucial here. Okay, examine the last learning objective. It talks about the consideration and steps introduced by the Bali FinTech agenda for developing a regulatory framework for crypto assets. Just read this particular thing. Okay, just read it out. Uh, it's really hard to remember all these things, but understand it. The Bali FinTech agenda is a global regulatory and supervisory framework for regulators that addresses fintech risk, including crypto and related technologies. So, what are the considerations for crypto asset regulation? Monitor any new development and technologies in the crypto space. Prioritize any resources, okay, which are allocated to jurisdiction. Scope of regulation to determine which aspect of crypto activities should be regulated, which one should be regulated, which one should not be regulated. And then domestic collaboration and coordination between various regulatory authorities to address specific risk. Continuous risk assessment to identify changing risk and provide strongest protection to markets and consumers. Just give it a good read. I would say that it's really uh, kind of like a very abstract thing, but just give it a good read, and you would be go and you'd be good to go with this particular chapter. Okay, so read this particular book. That's going to be very much beneficial. Reading 103, the digital resilience and financial stability, the quest for policy tools. Now, this is, but just give it a good read is all that I would say for this particular chapter. Describe characteristics of cyber risk and ICT risk. What is a cyber risk? It's a loss of confidentiality, integrity, and availability. It's also known as CIA triad, right? You need to have confidentiality, integrity, availability of data when it comes to data, right? This is what the thing is. So a loss of CIA triad is referred to as cyber risk. Okay, confidentiality is compromised, integrity is compromised, and it's not available. It has been hacked. So that's the cyber attack. The examples is the breaches of client information, unauthorized access to a system, funds theft, and the DOS attack. I'll have to check what is this DOS. Denial of service. Denial of service. So that is part of the DOS. Denial of service attack. Okay, something you have the system, but you're not able to access it. So that's denial of service. Importance of the cyber risk is that ranked as significant as market risk. Can you understand? As significant as market risk for a trading desk, we rank cyber risk in that same level. Challenge is that difficulty in estimating losses due to lack of reliable data. So that's a huge challenge. Hindered development of cyber insurance. And then there is also the development of cyber insurance is also very less, so that's the problem or the challenge with the cyber risk. When I talk about the ICT risk, it is the disruptions in information and communications system that may not stem from cyber attacks. So information and communication system has been hampered not from cyber attack. That is what we can club it, or we can refer it to the ICT risk. System has been broken down, right? Communications failure, service outage. That's the example of ICT risk. It is essential for ensuring uninterrupted transaction services. As a bank, you need to make sure that your net banking, your internet banking is working fine. That's the main thing. So it's very important. The challenge is that the dependency on technology, you're very much, everything is dependency on technology here, and it's vulnerable to system failures. It can happen. So that's a challenge, right? Now, there's a concept of cloud computing. Cloud computing, it benefits financial institutions, but comes with major risk when I talk about cloud computing. So you're shared the cyber risk with cloud providers. So like AWS, the Amazon Web Services, right? So you store your data in the cloud, right? So there's a widespread adoption increases systemic cyber attack. Multi clouds reduce single provider risk but introduce complexity. So rather than being dependent on one cloud service provider, you can use multi clouds, right? You can store some data in this cloud, some data in another cloud, but that can introduce complexity as well. Frequent outages raise concerns about potential disruptions. Frequent outages can lead to the ICT disruption. So they're going to be shared cyber risk with cloud providers, because everyone is using that cloud provider that is hacked. So the entire that's going to be having a widespread losses. That's what the cloud computing is. That's all that we need to know. Now, how the interactions happen between the cyber risk and the financial stability. Cyber and ICT risk at financial institutions can trigger systemic financial risk impacting the liquidity, leverage, and even the customer trust. As I said, this can be little abstract, okay, but just give it a good read, all that is there, not to focus too much on this particular chapter, okay. Integration and contagion effect. So now when you, how the interactions between cyber risk and financial stability happens, how cyber risk impacts financial stability. First is the integration with contagion effects. The highly integrated nature of cyber and ICT connections within the financial institution creates the potential for significant contagion effects. So if that is so, think about it. ICT risk, the net banking is not working, or maybe a broking company, they are doing transaction, right? They are trading. The platform is not working. That's going to be a loss to the investors and directly impacting the company, right? Cyber attack. So if they both happen at the same time, right, there's going to be a significant contagion effects. Contagious. That's what the thing is. CIA, confidentiality, integrity, availability of data triad. It stands for this three key principles of cyber security. The impact of cyber incidents on these can vary, and you just got to remember this particular thing, okay? How does the cyber risk and ICT risk impact the CIA triad? How does it impact? Well, if I talk about cyber risk, it can vary. Integrity and availability are often more critically affected than confidentiality. So integrity and availability is more critically impacted when there is a cyber attack, as against, so integrity, compromised data, availability is not available. Confidentiality is not so much of a concern when it comes to the CI triad for this cyber incidents. Challenges in predicting probability. There is a difficulty of predicting key events due to non-linear contagion effects. So now this is you really do not know what's going to happen, right? You really don't know what's going to happen. How can you predict what is going to be the loss for cyber attack or ICT risk. So it's a non-linear thing. It's not going to be like, okay, the event is this much, the loss is this much. No, it can it can be a non-linear like this. The losses can go very high, right? So we don't know. So that's again a challenge or interactions between the cyber risk and financial, how they interact. Now it becomes really hard to trace the systemic risk. You cannot trace it out. What happens is that if there is a cyber attack, let's suppose that if there is a cyber attack, okay, just a minute. So something that we are missing here is this. So challenges in predicting probability. Now there is a difficulty of predicting key events to non-linear contagion effects. We know that the contagion effects can be non-linear. So what we do is we use agent-based models for simulation. Here, what we do is we use agent-based models. Agent-based models assess impacts on confidentiality, integrity, which influence liquidity. So what we are trying to do is that we understand that to predict losses, right, of or probability of these events, it's a non-linear. It's not a straight line. It's rather, it can be a non-linear path like this. So what we can use is we can use an ABM or agent-based model for simulating the effect on the CIA triad. That's what we can use as an improvement. That's what suggests, which will influence the liquidity and asset values and everything. It will do that. It will help you a simulation, just like a Monte Carlo simulation. That is what the point here is. Now, the next thing is that tracing the systemic risk. It is hard to trace the systemic risk. Cyber attacks might block direct actions like a bank withdrawals, but can still cause financial contagion indirectly. Think about it. There is a cyber attack in a bank. The bank stopped the net banking so that no one can transfer it via mobile phone. But at least I can reach out to I can go to a bank and I can, or an ATM, and I can withdraw it, right? So it's really hard to trace out how the financial contagion or financial impact will be. If there's a cyber attack in my bank, if I cannot access the system, I'll immediately go to the ATM and I'll take my money out, right? So to trace where and exactly what is going to be the system-wide risk, it's really hard. So we can use, again, agent-based models here for simulating the behavior of individuals, like how I will behave to identify and understand hidden and systemic risk when it comes to ICT cyber risk. We are very much reliant on digital infrastructure. Financial institutions depend heavily on digital infrastructure, including the cloud computing. So quick recovery from cyber incidents is essential to maintain financial stability and continuous operations. Just pretty basic. Impact on customer confidence. Cyber risk can diminish customer confidence, potentially leading to bank runs and systemic financial instability. So that has an impact on the customer confidence as well. Okay, now this is something that you can just use it out. Specifically, the macro prudential tools are something that you should know. But financial stability policies, how can you ensure the financial stability? What are the policies and tools? Two ways that you can do it, on a micro-oriented tools and the macro-oriented tools. So digital resilience, what is it? Protecting digitally resilience, bouncing back. Protecting financial systems from cyber and ICT risk requires a two approach. Micro, that's operational guidance for individual entities. Framework policies, it's the fundamental rules for network and system operations. Okay, it's two things at an individual level and framework policies for that. So now we're going to be talking about two things here. The first one is the policy measures and micro level or micro oriented tools. Okay, micro oriented tools. So IC is the International Telecommunications Union. It implements, so this is just a union, okay? It implements cyber resilience measures, emphasizes certification and standardization for effective cyber security. Just like ISO standard and everything, you can just compare it with that. European Union, it established policies for incident reporting and information sharing. If there's a cyber attack or ICT risk, what happened? Report the incident, share the information. That's what the European Union. There's also a DORA Act, Digital Operational Resilience Act, focuses on ICT third-party risk, including cloud computing, mandates penetration stress test to improve. So this is just to give a good read. No need to remember it, and no need to get too much deep into it. Okay, just the policy measures on a micro level that you can do it for incident reporting, information sharing, implement the cyber resilience measure, have a certification of the International Telecommunications Union certification for that, standardized, right, for effective cybersecurity. That's the policy measures and micro level oriented tools. At a macro prudential tools is the first thing that you use is circuit breakers. Now, circuit breakers act as a temporary pause on normal rules and regulation. They provide a temporary stoppage to some services. Think about it. If there's a cyber attack, right, you can stop the net banking for about, let's say, 30 minutes as an example. So you can inform people and that, okay, or maybe you can just stop it, the services temporarily, you just stop it 5 minutes, 10 minutes, so that you have time to recover from that cyber attack. So that is what we call it as a circuit breakers. Okay. Circuit breakers act as temporary pause on normal rules and regulation. They give us temporary stoppage to some services. In the event of a major cyber incident, circuit breakers serve to minimize the negative impacts. Okay, so that you can just get back to, you can get back to, or you can take care of that particular risk, or there's a service outage, anything like that. So challenges include defining the severity of a cyber attack to warrant the activation of. So when do you activate this circuit breaker? That is a challenge. Now that totally depends on the severity of a cyber attack. If it is small level, high level, what is it? That's what the thing here is. So that's the circuit breaker. It's a good tool that you can use to have a temporary block on your services for a certain point in time, and then you just bring it back. Okay, so that you get enough time to work on it. That's what the point is. However, the challenges is that what is the severity, and then you activate the circuit breakers. The second is that of a cooperative arrangements. So cooperation among financial institutions has become essential for developing robust defenses against cyber attacks. So if there's a cyber attack in one bank, let's say that, then if you get to know that, okay, do not use this particular thing, do not visit this website or that phishing email, whatever that is, if there's a cooperation among banks or financial institutions, you can share it, the cyber attack details, and that, so that others can stay away from that. Information and knowledge sharing resources. So information and knowledge sharing resources facilitate growing cooperation to combat cyber threats. So have good information and knowledge sharing. That's what the thing is. Structurally, you can do something, create a structure, you can take a structural measures for that. So regulating systemically important technological institutions, not financial, technological I'm talking about, you can regulate them, okay, who are very technologically important, right? Forced diversification, you encourage the institutions or bank to use multiple cloud providers and not being dependent to just one cloud company. Penalties for concentrated software use. If you're using a software very heavy dependent on that particular software, there's going to be some sort of a penalty for that as well. Now, ICT buffers is something, the information communication technology buffer is a part of collaborative measure aimed at combating systemic risk and ensuring rapid recovery from major cyber attack. If there is anything, you have certain amount of buffer. Co-owner bank. So what can be doing is that, let's say in my bank, there is a cyber attack. So next to me is another bank. So that another bank can allow my customers to transact on that. So that's a co-owner banks affected by cyber attacks can allow customers to transact on their accounts at unaffected banks, reducing the overall risk. So that's something that we have it here. And I think just a good read is all that is needed for this particular chapter that we have.